everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Goldilocks or the Three Bears? Who you got? Live from Studio 2 at Bloomberg World Headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. just about 2 hours ago. And we're looking at a little bit of a rally. The S&P 500 trying to hang on after we got hotter than expected data when it comes to consumer sentiment and consumer inflation expectations this morning. The S&P 500 still up on the week, but really just trying to cling to those gains. Big tech doing a better job of that. The NASDAQ 100 up 0.2%. You look at the bond market, we're seeing a bit of a U-turn there. We've been talking about the bond rally that we've been seeing. Now you can see yields climbing up almost 12 basis points on the 2-year yield. Still a far cry from 5%. I want to end on XLF. Of course, this is an ETF that tracks the financials. It's down today to the tune of 0.5% or so, Romaine, as those big bank earnings finally kick off.
Yeah, those big bank earnings did kick off this morning, Katie, and so far, well, I guess so good. We talk about the results that we got here. JP Morgan posting a record profit. Wells Fargo logging more net interest income than expected. Citigroup benefiting from bigger credit card balances and, of course, the higher interest rates that it gets to charge on that carry. A conversation later in the show with Dick Beauvais on the results today and the other banks set to report next week. CFO of Wells Fargo, Mike Santomassimo, going to be joining us in just a bit as well. Meanwhile, investors on standby for details on the first ever special rebalancing of the NASDAQ 100. Now, this is a rebalance that is intended to prevent fund managers benchmarked to indexes from violating SEC diversification rules. And of course, it comes against the backdrop of a half dozen or so mega cap tech shares powering the overwhelming majority of market gains in the first half of the year, most concentrated gains in a 6-month period since the turn of the millennium. Now, that could have big implications for the stock rally going forward, but so too could the trajectory of the dollar. Katie Greifeld, modest strength in USD today, but not necessarily enough to overcome the downdraft that we've seen on a weekly basis.
On a weekly basis, and if you look on a year-long basis too, it's been pretty dramatic looking at the dollar fall from its highs that it started the year with. You're looking at the DXY here, and you can see we're down pretty sharply from where we entered 2023. So much so that actually, if you look at its RSI, you can see that we're now in oversold territory, which could trigger some buying. But if you take a look at how funds are actually positioned, let's look at the CFTC data here. You can see that on a net basis, leveraged funds, including hedge funds, are actually net short against the dollar to the most since it looks like 2021. So, Romaine, it looks like from here you have fund managers betting that those dollars declines that we've seen to start the year are going to continue.
Yeah, this has certainly turned into one of the bigger stories stories, at least of the week, maybe potentially of the second half. Terry Wiseman joining us right now. He's Macquarie's Group's Global Interest Rates and Currency Strategist. And I do want to start there, Terry, kind of with the importance, if you see it that way at all, of the moves in the dollar for the rest of the cross-asset space.
Well, yes. I mean, to the extent we get a weak dollar, certainly any corporations globally, any sovereigns globally that are indebted in dollars, it makes it easier for them to service their debt, right? The capital markets globally are dominated by dollar financing. There are a lot of borrowers in dollars who earn their revenues in non-dollar currencies. Whenever you have a weak dollar, it tends to make debt servicing costs for the global economy, global borrowers easier. So that's usually the benefit that we see from a weak dollar for the global economy.
Of course, what got us to this point is, of course, all the hand-wringing over what the Fed has been doing, Terry, and of course, I guess trying to read the tea leaves of economic conditions and whether we are indeed headed towards a recession here. What do you make of some of the market positioning that we've seen over the past few weeks in reference to those issues?
Well, I don't think that what is causing the dollar's weakness currently has anything to do with the U.S. recession. If anything, the data from the last few weeks out of the U.S. has been okay. It's not something that's pointing to an imminent decline. I think the reason the dollar is weak is really because the markets are increasingly convinced that we are seeing clarity with regard to peak Fed funds rate in the U.S. And that clarity has been offered most recently to the market by the fact that the CPI, the June CPI inflation print in the U.S. was not excessive, that it was in line or slightly lower than where the market thought that the inflation would come in. And now because of that, the market is betting that sometime in the next few months, the Fed will stop raising interest rates. Now, I have to say that although that's the way some people in the market are seeing it, to some extent, a lot of us out there have been anticipating a more forceful decline in U.S. inflation, i.e. a better disinflation, because we've seen it in some of these leading indicators of inflation for the last 8 months. Producer price indexes have shown globally less inflation. Survey-based measures of inflation have come down. Inflation expectations have been low. Mm-hmm. And we've seen other individual measures of business costs come down too, whether it's freight rates, for example, or energy prices, mineral costs. All of these have come down. So it was pretty inevitable to a lot of us that inflation was eventually going to come down. A lot of us had pegged the second half of the year for that to happen. And we also said that inflation would start to come down more rapidly in the U.S. than the other countries, especially other developed markets. That has happened as well. Europe and the UK are still struggling with high inflation. But because the Fed is now entering a period where we see more clarity with regard to when the Fed funds rate is going to peak, mm-hmm. that has weakened the dollar. Eventually, this disinflation narrative or theme will spread to the rest of the world.
Well, you talk about... Sorry to break in, but you talk about that clarity that we've got on the Fed's funds peak potentially approaching here. But then you look at the 2-year Treasury yield where these Fed expectations are being priced in, and the volatility has really been breathtaking. Above 5% last week. I believe we were looking at 4.6% at some point this week. With that clarity that we've gotten, why are things still so volatile when it comes to the Treasury market?
We keep in mind we've gotten clarity, but it's exactly because we've gotten clarity that things might be volatile. When you get clarity on something that was uncertain before, opinions shift, positions shift. That creates an amount of volatility until such time as a new frame of reference, a new outlook is adopted by the market. We may still be in that transition phase. I didn't say that everyone agrees that we're getting clarity on where Fed funds will be peaking, but I think to some extent a large part of the market is, but that has happened over the last few days. It wasn't the case certainly 2 or 3 weeks ago that the market was convinced that the Fed would stop raising rates, let's say, after one more hike. The market is clearly getting more inclined to believe that only one more hike is going to happen.
Mm-hmm. And if one more hike only happens, and we don't have too much time left here, you look at the 2-year yield currently around 4.75%. Should be closer to 5% or to 4.5%?
You know, I think the 2-year yield is actually fairly priced because even though we're getting more clarity on peak Fed funds rate, it doesn't mean that the Fed is going to be inclined to cut rates aggressively. And at the same time, to the extent that disinflation continues to come down, it's unlikely that we're going to see the 2-year yield rise either. But if you want me to make a market call here, I would make one in the belly of the curve, actually a little bit beyond the 2 years point, maybe somewhere around the 5-year yields. Those could continue to come down. The reason I point this out, though, has little to do where the Fed is, but it has a lot more to do where market positioning is. If you look at the positions of traders reports coming out of the CFTC, the market apparently came into this U.S. CPI print very short, the Treasury market, and especially very short in the belly of the curve. I think it did that because it believed that there was going to be a lot of Treasury issuance after the debt ceiling issues were resolved. But just as the market got very short, we get this low CPI print, and maybe we're going to see a wave of short covering that takes the 5-year yield convincingly below 4%.
Terry, great to catch up with you. Terry Wiseman there, global interest rates and currency strategist over at Macquarie Group. Coming up here, a conversation with the CFO of Wells Fargo, Mike Sanamissimo, on the back of a surprisingly good earnings report.
Plus, U.S. consumer sentiment soars as inflation comes down. We'll discuss what it means for the economy with Laura Raim. She is FS Investments chief U.S. economist. And a wild, wild week for the crypto space, including a federal court ruling that Ripple is a token and a security, except, well, when it's not. We'll discuss that and so much more coming up in just a bit. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
Well, JP Morgan, Citi, and Wells Fargo all reporting results this morning. Abigail Doolittle joins us now with the breakdown.
And it's a much different picture now, at least stock-wise, than it had been at that time, Katie. As you know, at that time, early this morning, pre-market, when these big banks initially reported, we had big gains, lots of green on the screen. A lot of these stocks, these 3 stocks, up 1 to 2 to 3%. At this point, we still have JP Morgan, which reported record revenues up about 0.5%. Wells Fargo up about 0.2%. Citigroup, though, not so much. Let's break it down just a little bit more. I was talking about JP Morgan's record revenue, $41.3 billion, plus their net interest income, also a record. Yesterday I was doing a preview. A lot of analysts were worried about the idea that these banks would not be able to control the interest expense, but that simply has not proven the case. Wells Fargo raises its net interest income view, very positive. Citigroup, though, analysts are saying less impressive, although I will note that Wolf actually liked their results, including the net interest income outlook. Now, into today, in fact, over the last couple of months, basically the beginning of April, so taking away a little bit of that Silicon Valley Bank decline, if we compare the banks to the S&P 500, we're going to see the banks at this point, this is the S&P 500 Bank Index, has regained some ground. Now, if we looked at this year to date, the banks are still down, so the banks are still underperforming the S&P 500, but over the last 3 months, less so. And then finally, Wells Fargo, I was talking about that net interest income. Let's take a look at what happened, because very positive. You can see moving essentially in the right direction, and $13.1 billion in the second quarter, Romaine. Well, that was a beat, and they did, of course, raise their guide by, I believe it was 10%, I read here. So very, very positive. Actually, 14%, even better than 10%.
That's right. They're going from 14 from 10%, and of course, the bump up in that guidance, they're certainly stole the show. A pleasant surprise for investors. Pleased to say that the CFO of Wells Fargo joins us right now, Mike Santomassimo. Mike, let's just start off with net interest income. There's been so much talk here about deposit betas and the balance between that rise in interest rates and sort of what it means for a bank like yours. What gave you the confidence to bump up that net interest income target?
Yeah, well, first, Romaine and Katie, thanks for having me again. You know, what you saw in the quarter, again, is just, you know, good continued strong performance there. And what we were looking at throughout the first half of the year is what was going to happen with deposit balances, what was going to happen with the mix of non-interest bearing or interest bearing, and what was going to happen with pricing, really driven by, you know, what was happening in the competitive environment. And as more time went by, we got more confident that trends were going to be a little bit better than what we had modeled earlier in the year, and that's why we were confident to put out, you know, the higher guide today. And I think it's a good sign overall that, you know, it's what's happening in the economy is probably better than what we all expected. And you know, you see good activity in the market. You see, you know, our NII is up quite a bit. You see fees up driven by that activity. You see good controlled expenses in the quarter, and I think that's really what's driving, I think, our results today.
Interesting too, taking a look at trading revenue and fee revenue, not something, at least relative to some of your peers, that a lot of people look to Wells Fargo to dominate here, but there was significant outperformance there, released relative to what we heard today out of Citigroup and JP Morgan. What was the driver of that?
Yeah, and keep in mind we're relatively small, you know, compared to some of the, you know, the big peers out there. But it's something that we've been focusing on now for the last few years, and just really making sure that we're consistently adding the right people. We're investing in technology, and really the focus is to just support our clients better. You know, it's focused on the U.S.-based clients for the most part. There's some outside the U.S., but really primarily here in the U.S., and it's just supporting our corporate clients and our asset management clients and others just better and better each day incrementally. And so we're happy with the performance we had this quarter and last quarter, and I think that shows through the fees. But it's something that we'll just keep, you know, gradually building on over time.
Mike, let's talk about commercial real estate, because it caught a lot of eyes that actually Wells Fargo increased the allowance for credit losses by about $950 million, and it was commercial real estate office loans that were cited for the reason behind the move. So as I understand it, you haven't seen significant losses yet, but you had CEO Charlie Scharf say that you expect to see it play out in the market over time. When are you anticipating to see peak pain for commercial real estate?
Well, I think I would just broaden it a little bit first, then I'll come back to office. And you know, when you look at the overall credit picture, it's quite good. You know, on the consumer side, we're seeing a little bit higher charge-offs, but that's off historic lows. And so, you know, that's actually performing quite well so far. And broadly on the commercial side of the business, it's going quite well in terms of both the, you know, our middle market and commercial banking clients, and big chunks of the commercial real estate portfolio are actually performing really well so far, particularly given where we we are in the cycle. And so really this conversation is focused and isolated on the office portfolio. And I think as you look at office, it's a lot of the trends that we all are talking about now for a while in terms of return to office, companies needing less real estate, and that's starting to come through in different cities and different properties across the country. And what we did today, or in the quarter, is make sure as we sort of look at all the things that we can see and then think about a whole bunch of different scenarios that we stress in the portfolio, and so we built a reserve that we think is appropriate to deal with a number of those scenarios. But keep in mind, we haven't, as you said, we haven't really seen the losses be significant so far. But there will be some weakness over time, and it'll play out over an extended period of time, and likely years, not months or quarters, as people work through the changing patterns and different issues with individual properties.
So likely years, we'll put a pin in that. Let's also talk about deposit betas as well, because you also said that the average deposit cost is now 1.13%. For context, it was basically zero a year ago. How much higher could that average cost rise?
Well, keep in mind, that's, a little over 100 basis points with rates going up 500 basis points, right? And so it's still, relatively modest given the quick pace of rates that we saw. And when you look at each part of the portfolio, on the commercial side, the pricing's been pretty competitive for a number of quarters now. We're not seeing that accelerate one way or the other. And so I would anticipate that'll just continue being pretty competitive as we go over the next coming quarters. And then it's really the consumer side where we raised prices last year, and we're seeing that flow through our portfolios today. And I think we'll just have to wait and see as the year goes on and we see what the path of rates look like. And I think that'll help us figure out exactly where that goes and what pace it increases or decreases over the coming quarters.
Mike, really appreciate the time on what I'm sure is a very busy day. Our thanks to Mike Santomassimo of Wells Fargo. Coming up on this program, a wild week in the world of cryptocurrencies, from court rulings to wild rallies. We're going to recap it all next.
Wild.
This is Bloomberg. Wild.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but X-Pen is X-Pen. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Well, crypto investors have been a wild ride all week here. Earlier this week, we heard that the Celsius Network founder had been charged with fraud. A little bit later, we actually heard that a federal judge had ruled that Ripple Labs, the token by Ripple Labs, I should say, is a security, at least when it's sold to institutional investors, but for some reason not to little old me and you. Elliot Stein over at Bloomberg Intelligence joining us right now to talk a little bit more about this. And let's start off with Ripple, because this was not only a pretty momentous decision, but somewhat of a head scratcher too. The idea here that if I pitch you on a Ripple Labs token and you're a big bank and I set this up as some sort of business related plan, there's a certain sort of protocol I have to follow. But if I just want to go to Katie and sell her something on the side down there on 59th and Lex, no problem at all.
Yeah, well, I mean, yesterday was a wild day, Romaine. I mean, you guys alluded to that earlier. First with the Mashinsky arrest in the morning, and then there was a hearing in the SEC Coinbase case, and it was during that hearing that this Ripple decision dropped. And I think you're right. I mean, it's definitely a very important case. It's one of the first cases that rejects one of the SEC's main theories in the crypto space. But, you know, there are some questions around it. It's not the end of the road. It's going to go probably up on appeal to sort of clarify some of the questions that you raised.
And how does the Ripple case, what implications does it have for Coinbase? Because at the same time, I mean, you have this enforcement action from the SEC against Coinbase. But as I understand it, this has some ripple effects in a good way for Coinbase.
Yeah, no pun intended, or maybe pun intended. But in any event, yeah, I think it's absolutely, it's a great decision for Coinbase as it stands now, because what this decision said was that direct sales to what the court categorized as institutional investors, you know, hedge funds and other sophisticated investors, those the court deemed to be securities. But other transactions, other sales of Ripple's XRP token, for example, on public exchanges, the court said are not securities. And so by that logic, sales of tokens on the secondary market or on platforms like Coinbase are most likely, pursuant to this ruling, not going to be securities. But again, it's not the last word. It's, you know, it's only one judge, one trial court judge. You know, other trial court judges, for example, the judge in the Coinbase case, she can be persuaded by this ruling, but she's not necessarily bound by it. Mm-hmm. So we'll see how it plays out in the appeals court and potentially in the Supreme Court eventually.
And Elliot, one of the reasons I was so excited to talk to you today is I was scrolling through Twitter yesterday and I saw this tweet from you, that feeling when you're in court for a Coinbase hearing, sitting 2 rows behind SEC lawyers when the Ripple decision drops. Just set the scene for us. What was the mood in the courtroom like, and why is this so important for the crypto industry?
Yeah, I mean, Twitter was on fire yesterday, and the courtroom was fascinating yesterday because, you know, you have this whole phalanx of SEC lawyers. You have, you know, Coinbase's army of lawyers on the other side. I'm sitting right behind the SEC lawyers in the gallery. And, you know, the Coinbase hearing is sort of this routine preliminary hearing. It's been going on for like an hour and a half. They take a break. They come back from the break, and I'm checking my phone. You know, I'm checking Twitter, obviously, and I see news that the Ripple decision came out. So, you know, I'm furiously trying to get the decision on my phone, and I see all the SEC lawyers, you know, all of a sudden their heads are down and appear to be buried in their phones too, presumably also reading the opinion. So it's, you know, it's one of these worlds collide issues. Meanwhile, Coinbase is raising a lot of the arguments that, you know, were germane to the Ripple decision. So it was fascinating.
All right, yeah, quite a wild ride here. Elliot, great to catch up with you. Elliot Stein of Bloomberg Intelligence. We'll see what next week holds as we close out the week here on Bloomberg Markets to Close. Markets on the back foot on this Friday, despite a relatively strong week over the previous 4 days here. You see the volatility tamp down in a big way with the VIX back down around 13, but a huge reversal right now underway in the Treasury space. Your 2-year yield up 12 basis points. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Markets to close, almost 2:30 here in New York. It has definitely been a wild week for crypto, but also a bit of a wild week in the commodity space. Abigail Doolittle standing by right now with our commodities close. Abigail.
It has indeed, Romaine, and here are some of the bigger moves on the day. Some mixed moves. New York crude up down 1.9%. Some analysts are saying that there's technical resistance there, and indeed it is back or near that 200-day moving average. In addition, profit taking. You can see the grains, though, are strong. Wheat and corn. Wheat is up 3.2%, and some are saying that this could have to do with the fact that the Black Sea Grain Initiative, it's up for renewal on Monday. It's unclear whether it will be signed, and one analyst is saying that this could really reintroduce an element of risk premium returning to the market. We seem to be seeing that today. Copper down just a little bit. Overall, the Bloomberg Commodity Index up slightly on the day, but if we go into the Bloomberg terminal and take a look at what's happening over the last 2 weeks, we can see, including this week, we're looking at 2 weeks of gains similar to what we had back in June. I wouldn't be surprised, Romaine, if this mainly has to do with the down dollar. Over this time period, the dollar down about 2.5%. Commodities denominated in dollars up just a little bit more than that amount.
Yeah, big moves in commodities, big moves in the dollar, big moves in the Treasury. The 2-year Treasury yield, which over the previous 2 days had dropped by about 12 basis points, up today by about 12 basis points. That on the back of the latest sentiment data out of the University of Michigan. That data soaring to nearly a 2-year high. We heard from the director a little bit earlier about exactly why. Take a listen.
This is a second straight month of huge increases in sentiment for consumers, and they're just really on the upswing right now. They're feeling much better than they were last year, and it's very much being supported by the continued slowdown in inflation as well as continued strength in labor markets.
Joining us right now is Lara Rames, FS Investments Chief U.S. Economist. And I guess this is kind of ratification, I think, of what we've all known, at least for regular folks out there, is that inflation, the prices that we see at the grocery store and at other retail establishments had really been weighing on sentiment for the last couple of years.
That is exactly right. I think, as we've seen disinflation start to really take hold in a more broad-based way in our economy, you're seeing this kind of breath of relief coming from the consumer sector. The number that we got this morning is from the University of Michigan Consumer Sentiment Survey, and that survey in particular is very sensitive to inflation. So some of the other measures that we've seen haven't gotten quite as big of a bounce, but net, one of the big positives of inflation coming down is real wages are finally making big year-on-year gains. And we saw those up 1%. Again, when adjusted for inflation, wages are finally higher.
Well, this raises a broader question, though, too. I mean, okay, as confidence maybe starts to tick back up, is that going to translate directly into, I guess, consumers pulling out their credit cards or those dollar bills and buying things? Is there a direct correlation there?
You know, there is, but I want to reframe the bounce that we're seeing in confidence, because from the various measures that we have, confidence has been significantly low, despite a really strong jobs market, despite a lot of other positives that are going for the economy. So I don't necessarily see this enormous bounce coming. I think we're seeing this sort of last cloud evaporate. So I think we need to be careful how much we're expecting consumer confidence to improve from here, particularly because we are seeing, you know, layoff announcements. We're seeing, you know, broader signs that the economy may slow. I think we want to temper our optimism about consumer confidence at these levels.
How does this sort of translate into Fed policy? Because it's been really striking watching the bond market try to come to grips with what this means for the Fed's path forward. Of course, we saw that big plunge in two-year yields after we got that better than expected CPI print. Now we're heading the other way after that hotter than expected consumer confidence reading. How do you think policymakers are actually viewing these data points in relation to each other?
Yeah, this has been the real dance of this week, the volatility that even these really sort of smaller data points have given us means that markets are still really wrestling, and the Fed to some degree may also wrestle with policy going forward. Because just because the Fed is pausing doesn't, and you know, they're likely going to raise in July, probably go on pause after that, does not mean the job is done. Because the minute that long-term rates come down, we start to see a lot of these interest rate sensitive sectors re-engage and re-inflame. I think the Fed needs to be really careful to explain to markets that just because they may be stopping the nominal piece of these rate hikes, they are not. The path to any kind of rate cut is incredibly narrow right now, especially with the economic data as strong as it is. And markets are really feeling this volatility, right? It's been an extraordinary week in fixed income.
Extraordinary week in fixed income. Yeah, I'm excited to see what the next week holds. But we're talking to you as earnings season kicks off. Of course, we saw some of the big banks toe the line today. Some interesting comments when it comes to credit tightening. You had the Wells Fargo CEO saying that they've taken some credit tightening actions. On the other side, you had JP Morgan CFO saying that they don't particularly expect there to be tightening in credit. When you weigh it all together and you think about the expectations you have for the banks we'll hear from next week, what do you expect the availability of credit to look like going forward from here?
That's exactly the kind of forward-looking indicator that I think is slowing, and is why I expect second half growth to be slower than it was in the first half of the year. Because, you know, this is the classic path of Fed rate hikes impacting the economy through this credit channel. I don't think it's going to be a credit crunch, but it's going to be this continued squeeze, and I think we're going to see that evolve throughout the second half of the year. Real estate is finding a new equilibrium. It is involving some decline in prices, especially in commercial real estate, sector by sector for sure. But as this happens, the banks are probably going to be at the epicenter of where that squeeze is happening.
Definitely a trend we'll be keeping an eye on, as I'm sure you will as well. Laura Raim, thank you so much. That is Laura Raim. She is FS Investments Chief U.S. Economist. Still ahead, JP Morgan's best quarter ever shows that big banks are in a sweet spot for interest rates. We'll dive into the numbers next with Argus Research. This is Bloomberg.
analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with AT&T. The shares at their lowest level going back to 1994. JP Morgan downgrading to neutral. This amid a swirl of concern about growth in both the wireless and the fiber business, and concern about AT&T's potential liability for contamination cleanup related to some outdated lead cables. Shares down 4%. Next up, KB Home getting a boost from Raymond James with an upgrade to outperform. This alongside a boost in the price target. The analysts there are citing strength across the home building sector, adding that while mortgage rates are up about 7%, there's still a long lineup of buyers out there for move-in ready homes because of that, quote, shockingly lean inventory in existing homes. Shares at KB Home at a record high, up 3% here on the day. And finally, let's take a look at Microsoft. Getting an upgrade today to buy over at UBS. The analysts seeing potential for Microsoft in the AI space and stabilization. And the legacy cloud infrastructure business says the stock too attractive to pass up and bumps his price target up to 400 from 345. Microsoft up 1% on the day. And those are some of our top calls. We do want to stay in the sell side space and have a focus right now on what's been going on with the banks. Earnings season did kick off, and we got three big bank earnings: Citigroup, JP Morgan, and Wells Fargo. A bit of a surprise to the upside for each one of them. Let's get some insights out of our next guest. Stephen Vigor joining us, Director of Financial Institutions Research over at Argus. And Stephen, let's start off with the big three banks that we got today here. Overall, it seemed like a relatively pleasant surprise. What did you make of it?
Yeah, I agree. I think, there was some lowering of estimates that came into the quarter here. So I think that's part of it. I think the banks, up until, many conferences before the end of the quarter, kind of guided lower on a number of things: investment banking, trading operations, higher funding costs. And, indeed, we got most of that. But by and large, the banks did pretty well. JP Morgan had only a 5% decline in investment banking fees, admittedly against a fairly weak quarter last year. as well, but that's not kind of the 15 to 25% that some of the other banks have been warning about. So we do see higher credit costs. Those things are happening, and slightly lower loan growth with higher interest rates here.
At least again, I obviously it's still very early in this cycle in terms of the earnings reports, but there does seem to be a bit more equilibrium. We were all sort of wringing our hands a couple of quarters ago about deposit betas and how the banks were kind of behind the 8 ball with that rise in rates.
Yeah, very much so. The topic of the earnings calls this go round is obviously much different. That crisis of confidence in deposits has gone away now. And they're focused just back on the basic business of banking, talking about loss provisions, about delinquencies moving forward, a slower economy, what happens with deposit betas and net interest margins going forward. So it's a much different tone. But yeah, they dodged a bullet, and honestly, I think there was quite an overreaction in the share prices of really across the landscape. Not so much for diversified banks, but certainly regionals were hit very hard, down 35-40% in that March-April timeframe. So they've got a lot of digging to do still.
So they dodged a bullet maybe on some of those worst case scenarios for deposits. But one of the big question marks out there, of course, comes to commercial real estate. We know that Wells Fargo increased its allowance for credit losses by $949 million, mostly related to those CRE loans. Should we expect more of the same when we see some of these other big banks take the stage next week?
I think so. Cautiousness is the name of the game today, and not only are they adding to provisions, obviously, but they're also pulling back on the credit underwriting in that space for obvious reasons. So there's a lot of vacancies. There's a lot of refinancings that are going to be coming due over the course of the next year and a half. In that space at much higher interest rates and with a lot higher vacancies and weaker cash flow for the buildings associated with particularly in the office space for commercial real estate. So I think banks are right to take the pain ahead of time here and try to build up reserves and just be if not adequate, robust would be a better word in terms of getting to a right point in terms of loss reserves there.
And Stephen, pushing ahead to some of the regional banks that report next week, including Truist, which I know you cover, you say that some of the worst case scenarios didn't materialize for these big banks. When it comes to the regional lenders, can we say that the crisis is firmly in the rearview mirror?
Well, I think for the large banks, we can say that crisis of confidence. If anything, the larger banks were a bit of beneficiaries of the deposit outflows from smaller banks that individuals had questions about in terms of their staying power and the large banks here, the globally systemic important, in particular, the ones that have the highest capital were beneficiaries of those inflows. And I think even some of the super regionals like the Truist, PNC, U.S. Bancorp, deposits will probably be down, but slightly, only low to mid-single digits. And, in the aggregate, it's worth pointing out that the Federal Reserve data shows that we get this weekly, that the banking industry lost about $1 trillion in deposits between April of 22 and 23, from 18.2 to 17.2 trillion. And they've gained back since April about 200 billion. So that's notable, particularly the competition we have for higher yielding alternatives for deposits right now. The people have faith in the banks, and we'll find out if that's only in the large banks when the smaller banks start to report next week.
Stephen, really appreciate the time. That is Stephen Bigger of Argus Research. And of course, there was a ton of reaction to today's results, including from JP Morgan CEO Jamie Dimon, who says that his rivals are, quote, dancing in the streets. That is in response to a question about the effect of increased regulation on his business model. Here to discuss is Evan Weinberger of Bloomberg Law. Dancing in the streets, is it really that dramatic?
It potentially could be. So what the Fed is talking about doing is really increasing capital levels on the biggest banks. And the banks say that, well, if you increase capital levels on us, it's harder for us to lend. A lot of activity goes to hedge funds and private equity and other alternative asset managers, and they can take a lot of our business, and the regulators can't see what's happening there.
But this has been happening for a while, Evan. I mean, this isn't anything new here. And I mean, they've had plenty of time to adjust, even before whatever latest conversation there is about some of the additional regulations.
Yeah, but what they're talking about now is actually fairly significant. So the Fed never actually finished all of the capital rules that it was supposed to do following the financial crisis. This is what's known as sort of the Basel Endgame, to give it a dramatic name. And it's finishing up what bank regulators around the world decided they wanted to do. And it's really going to make it so that banks can't, the Fed is not going to take the bank's word for it on their capital levels, and that could require a lot more moving forward.
And the banks, of course, also say that basically the proposals that Michael Barr put forward, they don't actually address the weaknesses, but have they suggested any alternatives? What would sort of prevent this from happening again?
Well, they obviously say that better bank supervision would help, throw it back at the regulators. And I think there's definitely an argument that there were some failures in bank supervision that led to the failures of SVB and First Republic and Signature banks. Also, I mean, they kind of look at it and say there were 3 banks that had very distinct business models that all kind of ran into a problem when interest rates rose. And the rest of the banks are pretty much doing all right so far, as you saw with the earnings today with the largest banks. But even some of the other regionals that are sort of on everybody's watch list, they're regaining deposits at this point and shoring up at least a little bit.
We should point out, I mean, in Michael Barr's defense, he did say that if this does come to fruition, and we know there are a lot of steps this has to go through, that it would be phased in. But there's also a bigger question here about the folks that Diamond says will be dancing in the street. Are they never going to face any sort of additional regulation, given how much more prominent they've become into our financial system?
They theoretically could. So the Treasury Department and all the financial regulators could join in and say, we're going to regulate, we're going to subject big hedge funds, big PE funds, big asset managers to enhanced supervision, similar to what the banks go through. They haven't done it yet. There's not really an indication that they're going to do it, but theoretically they could.
I would have like to listen to this conference, because, it was a great song, Katie. What was it? I know Mick Jagger and their Stones remade it, but it was like Martha and the Vandellas, Man Dancing in the Street. Was Jamie Dimon singing this at the time, or did he just sing?
I wasn't listening, but if I had known maybe there was a potential that he could sing, I would have.
I don't think that he sang, unfortunately.
All right, thank you.
Rats. Well, Evan, great to have you. That is Evan Weinberger of Bloomberg Law. Coming up, Larry Summers, former U.S. Treasury Secretary, shares his thoughts on the Supreme Court's affirmative action decision. That's up next. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Markets to Close. Time now for our Wall Street Week Daily segment. Larry Summers, of course, spent about 5 years as president of Harvard University back in the early 2000s. We had a chance to sit down with him to get his thoughts about the Supreme Court's decision on affirmative action. Take a listen.
Diversity is important, but what's most important is inclusive opportunity for every American, the sense that we can draw on the talents of everyone, and the sense that our society isn't limiting anyone, regardless of what their background is, regardless of what their race is, regardless of how long they or their families have been in the country. That's really what is most important. And that's really a much more important priority for thinking about what universities do than is thinking about this idea that how good the discussions are going to be depends on exactly the demographic composition of the class. We're all very complex people. Our perspectives are not primarily the product of our race. They're the product of a totality of life experiences that we have had.
If you were advising a major university today, how would you advise them to pursue your goal of the opportunity to excel for everyone?
I'd start by eliminating legacy admissions and admissions for people who play sports that are highly aristocratic. Second, I'd make a big effort to look through people who've been extensively coached for the SATs or extensively coached as they wrote their essays and so forth, so that I wasn't giving credit for whatever your parents' money can buy. Third, I'd be thinking very hard about expanding the size of moving to be fairer. Just as many years ago, it was the case that top schools had huge preferences de facto for students who'd gone to elite private prep schools. And that was often defended by saying they came from wealthy families and it could support the schools. But those policies gave way. And I think everybody at schools like Harvard would say they are much better off because those policies gave way. And I'm pretty confident that a decade later, no one would miss legacy admissions and people would take it as a given that legacy admissions were not part of our system.
And the former president of Harvard University there sharing his opinion on the affirmative action decision from last week. Be sure to check out Wall Street Week, 6 p.m. New York time. Mona Mahajan, Dennis DeBuscher, Catherine Judge, and Afsani Beshlaw, some of the guests on tap. Meanwhile, we continue to set you up.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. It is Friday, July 14th, also known as Bastille Day, and a happy anniversary to my sister and her husband, because it's their anniversary.
And
cool?
to France?
And to France,
kind
yeah.
of.
That's where they went on their honeymoon.
Yeah.
He's got some French in his background. Anyway, a very good afternoon. It is Friday. It's a big bank earnings day. What?
Can I leave just a little bit early?
No.
Like 5 minutes early?
No. Okay, I can't believe this is what he drops on me.
I need to make a boat.
This is what he drops on me. We have a lot to get to. Carol Masser, along with Matthew Miller, in for Tim Stenivek. Nothing to say. In our Interactive Broker studio on YouTube and Bloomberg Originals, you know, some of us have to wait till 6 p.m. to begin our weekends.
I just want to go at like 5:55 if I could.
Well, think about it. All right. Coming up, we're going to talk about the markets, folks. We did have the S&P 500 and the NASDAQ hitting fresh 52-week highs today, but man, they have backed off big time, Matt.
Yeah, and financials are one of the biggest weights on the index. Actually, so many assets have turned around, right? Treasuries are getting sold off today, and we had seen big buying in treasuries over the last few sessions, yields coming down, now they're going back up again. Oil had been shooting up over the last few sessions. We saw NYMEX crude over $77 a barrel. Now it's going back down, and energy is actually the biggest weight on the index. The dollar had been dropping. It's rising a little bit today. So everything's kind of turned around on this Friday.
That's because we got some sentiment numbers, right? And inflation expectations among consumers, they were upbeat. And so maybe
amazingly
a
upbeat.
Little bit of a rethink.
The most upbeat since September of 2021.
That's 2 years, Matthew.
Amazing.
All right. We've got Bitcoin, though, down about 4% here. Having said that, we're going to talk banks. We're going to talk about the markets, because it has been quite a week when it comes to both treasuries and to the equity side. We're also going to talk about Hollywood. A lot going on. Writers and actors both striking, if you will.
So nothing going on.
Yeah. That's so true.
We need a laugh track.
Yeah, we do. We're also going to get to one of the world's richest looking to buy talent agency, CAA. I'm thinking, is he buying it for his wife, maybe?
Oh, is that Selma Hayek?
Yeah, that's her husband.
Cool.
Hello, hello. Did you read in today?
Yeah. I mean, I knew who Selma Hayek was married to. So.
I know. We were talking about crypto stocks surging this week, although even with Bitcoin down, a big ruling yesterday. And then we're going to get into the latest installment. Drum roll, what Matt Miller is driving.
Yes, and it is a very special vehicle.
It's green and mean. Right now, though, countdown to the close starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues Matt Miller and Pink Friday, Carol Masser. Welcome to our audiences across Bloomberg Television Radio Originals here as we kick off a wild earnings season with banks. I think you missed the memo, Carol Masser.
We're kind of leading. We're leading all this next week. We're going to be in pink.
You are pioneers.
We are. Let's just get to, we'll talk Barbie later, but let's talk about the banks. And we were so worried about them because check out the results, although the trade definitely showing a different story right now. But you had big banks, JPM, Citi, of course, Wells Fargo reporting. You had JP Morgan having its best quarter ever, a record profit. JPM and Wells both lifting forecasts for revenue from loans. Citi showed a strong jump in revenue because of credit cards. A lot going on. And those stocks, except for Citi, JPM and Wells Fargo, Matt, earlier really rallying, but they've all really pulled back. I think only JPM has a slight gain right now.
Yeah, it seems like a lot of them have turned around, and actually financials are one of the biggest weights on the S&P right now. So along with energy, as oil has retreated as well, a lot of assets have done an about face from what they were doing the last 3 or 4 sessions. Financials are dragging on the index. Even though net interest, I should say, margins or net interest income was better than expected. So for the big banks, it wasn't as much of a problem as we still expected to be for the regional banks as deposit costs get up so high and loan costs aren't bringing in enough revenue.
Well, we should point out, though, I mean, there are some other financials that didn't do so well. I mean, I was looking at the State Street earnings. Those shares are down like 11%, and that was because their net interest income some measures actually missed expectations. And then you had a lot of concerns about the results that we got out of BlackRock, particularly when it comes to fund flows. Those shares, I think, down a couple percentage points here. So kind of a mixed bag for financials overall. I mean, I know it's still early, but in the earnings season, but it'll be interesting to see what happens when we come back on Monday and get the rest of the cohorts.
And I'm really excited to see Goldman next week. Of course, we were talking about earlier this week that they've been really downplaying expectations. We'll see what they deliver next week. But I want to talk about Fed speak. And Romaine didn't seem too psyched when I brought this up in the meeting, but I thought it was really interesting what we heard from Fed Governor Christopher Waller, because he spoke after we got those inflation figures, and he said that I see 2 more 25 basis point hikes over the course of this year. So that's not what the market is pricing in. It feels like we're setting up again for another Fed versus market showdown.
Well, it'll be interesting too. I mean, I don't think his comments are that far off from some of the other ones that we've seen. But it gets to the whole question here about sort of, is that unanimity that we've seen on this whole march higher in interest rates, is that finally over with regards to the FOMC members?
What I really loved what he had to say in his speech, and he argued that basically if you're all waiting for that long and variable lag to happen, hey folks, it's already left the station. That to me was really important. And then you look at the sentiment numbers today, it kind of says that like even consumers are like, okay, maybe everything's okay. Like I just thought it all fit together.
It also was my biggest takeaway. I immediately saw that, and I know because we always ask economists how long they think these long and variable lags are going to be. You know, Danny Blanchflower has said 12 to 18 months. Torsten Slok has also said 12 to 18 months over at Apollo. So it's interesting to me that he said, that Waller said, they are hitting the economy now, and we don't need to expect them to come out of a pipeline and hit us like a sledgehammer next year.
Which is why he says we need more rate increases, essentially, right?
Yes, he said 2, but maybe 1.
Right.
Maybe 1. I mean, we'll see. It seems like July is a lock. After that happens, the conversation we're having, maybe it'll be different.
All right, guys, wardrobe is coming. They're bringing you your pink gear in just a moment. All right, guys, we're going to be back. We've got more to talk about.
Okay, go ahead.
What?
No, we'll talk later, Carol.
All right, I bet we will.
Keep the line open.
I will. Your people, you can call my people. All right, guys, we will be back in less than an hour's time. Our cross-platform coverage, we're going to count you down to the closing bell on this Friday, wrap up the trading week. The 4 of us will be back, radio, TV, YouTube, and of course, Bloomberg Originals. Join us at 4 for Beyond the Bell. The week. It's something we've been counting down to for a while. So let's get to it. We just kind of gave you some of the highlights. JP Morgan posting record revenue on rates in their First Republic deal. Citi getting a credit card boost, but borrowers, though, are starting to struggle. And of course, we had Wells Fargo earning more net interest income than analysts expected in the second quarter, also lifting its guidance for the full year. So with us right now is Ken Leon, analyst at CFRA. He is on Zoom Matt in New York City.
That's excellent, Ken. Thanks so much for joining us. I was listening to your comments on surveillance earlier this morning. I wonder why the street was a little bit surprised by the strength of net interest income or net interest margins. It seemed like we all expected the big banks to have to pay up for deposits and not to make as much money on loans, but they have strong loan demand, and of course those deposits flowed to them for free.
It's great to be here. And somewhere in one of my reports, I have a great chart that shows the mechanics of net interest income. But the bigger picture is the U.S. economy is resilient and growing. We've seen loan growth that was way above expectations, particularly for commercial loans as well as consumer. That feeds into the loan volume that with higher rates gives you higher net interest income. Rates are expected to peak, pause, and then decline next year. Spreads are likely to narrow as deposit costs continue to be higher. But the picture is still good in the total net interest income and elevated net interest margins. Put that all in terms of English, it means growth for the banks versus some concerns about reaching a peak and declining. So we don't see it yet.
All right, Shonali's also with us. Shonali Bostic, Wall Street reporter at Bloomberg News. She has been up. I don't think she even went to bed because she has been just writing and keeping us all informed about these results as they rolled out. It is the big bank, Shonali. It's also State Street. Romaine just reminding us that they sunk after net interest income dropped, so their share price has been under pressure. But Shonali, when you look at the results, what does it tell you? And I do also wonder, especially when we focus on the big banks, is that a very unique sector of our corporate economy as well as our retail economy?
Well, we're going to find out very quickly, aren't we? Because so many regionals report next week. But when you look at the big banks, something that I think a lot of people are having a hard time wrapping their head around is this short term, this idea that JP Morgan not only had a record quarter, they're about to have a year in which they're going to bring in more net interest income than they ever have before. More than $30 billion more in net interest income than they were making 2 years ago. But if you look at the data on credit deterioration, the delinquency rates for credit cards are much different outside of the top commercial banks than they are at the biggest of the big, which are relatively conservative and want to lend more, so are willing to take on some of these losses that JP Morgan says are normalizing rather than deteriorating. But the longer term, guys, is also what kind of overhang is the new regulation going to bring? And certainly a lot of the bankers got questions about that on the call today. And I think a lot of people got a kick out of Jamie Dimon's comment about Apollo and Blackstone dancing in the street for activity moving outside of the banking sector into the non-bank, and how much business they could take on as a result of that.
The shadow banking system.
Don't call it shadow banking.
Oh,
that's what they say.
Well, Ken, what do you think about the shadow banking system? Are they going to encroach on big bank territory here?
They're out of harm's way, and they are half of the U.S. financial system. They're getting whopping returns related to credit. Many times it's non-rated types of debt that they're doing. They do it extremely well. So when the pickings, you go back since the financial crisis, banks were really pared back from making principal investments like private equity, and then you got the credit side. So there's a bone to pick here for the U.S. banks that, lo and behold, are going to have to go through all the new ratios and framework proposed by Michael Barr with capital buffers. So Shonali's right. This is a big deal. Where it has impact on investors is, does this in any way suppress return of capital, particularly buyback? We're not sure yet, because these banks are generating so much earnings and available capital that this will be the yin and the yang conversation, over the next 12 months.
Ken, I want to ask you, though, is it right to call them shadow banking? I mean, Matt and I talk about this a lot. We're both kind of blown away in the last few years. I feel like the amount of attention, and rightfully so, on the private credit space and the private banking space, if you will. But do we have enough transparency? Should we be concerned that maybe we don't?
Well, shadow banks really, started where it was viewed to be lower quality. It was consumer finance. It would be those making auto or personal loans where the FICO scores were low. Put that aside, now we're talking about the cream of the crop credit opportunities that firms like Blackstone, Apollo, and others are really taking the opportunity. That's principal investment that they're getting high returns. The worst story for a bank is to be an agent for principal investors where they just get a commission. It's better if they can get a return on a principal investment. And I think this is something that obviously the large banks can do well, Morgan Stanley, Goldman, or JP Morgan, but they've been restricted. So I think this is a debate that should happen in Washington. It hasn't so far, and that's what makes the shadow banking situation quite interesting.
Really important differentiation, though, there, Ken, so I'm glad we got that. Shonali, what did we hear from the big banks that reported today about demand for loans? How much do consumers care about higher rates?
That's an interesting question here, because you've seen it quarter after quarter in Federal Reserve data as well, that it's not like there's crazy demand, but at the same time, credit card growth, was double digits for Citigroup. And when you looked at JP Morgan, it still grew quite meaningfully in the high single digits, although the rate of change for new debit and credit cards was less than the last quarter, which, tells you something, but it's still that they are still extending loans to consumers. I think something interesting and undercounted is that Jamie Dimon has been saying all the year that the consumer cliff would kind of come at the end of this year, which draws questions about what next year starts to look like. You know, Jamie himself was asked a few times on the call about what normal looks like. What is the normalization when you look at net interest income? And it's really hard to look over the horizon and see how much money these banks are really going to bring in outside of this year. You saw pressure on some businesses, obviously, already. You saw, you know, trading, investment banking, and, you know, debt underwriting for, you know, on the corporate side is coming back, but not in this huge kind of way either, which shows you that there's, even on the corporate side, some demand, but it's not crazy demand.
You know, and I do wonder, guys, how much we were managed. I feel like, you know, all of the stories that we were doing leading up to it is like, oh my gosh, we've got to be worried, Ken. Were we managed in a big way? Or maybe when it comes to Goldman next week, that will bear fruit and it will bear out those concerns?
Well, very different situations, but I think the point to be made on net interest income is that analysts will be conservative and forecast lower next year, but there could be a surprise with a resilient economy and possibly a reverse of loan reserves for consumer credit, et cetera. We'll see. The storyline, I think, and I know Bloomberg's been playing up the Goldman story, is Bank of America. It's down 13% this year. It's really underperformed the Big Six and the S&P 500, and they don't have a problem child in terms of lines of businesses. There was interest sensitivity, but you know, overall, I expect Bank of America to do superb on Tuesday. Goldman, it's basically, you know, will management flinch given that they're going to have significant takedown or write-offs on their diversification into consumer, green sky, et cetera. And it may not be good enough just to say, in our core businesses, we're going to gain wallet share over the next 12 to 18 months. But that they're supposed to do that in investment banking and other areas. So the key is, you know, where Goldman has to catch up in investment and wealth management. So it's a challenge. It's a real challenge because its competitors are doing well in that category.
Sonali, what are you, I mean, aside from sleeping, what are you going to do this weekend to prep for next week?
Well, I mean, you know what's interesting about what Ken's saying here is Bank of America coming into this morning was trading a little below book value. Wells Fargo was doing better. You know, what are they doing to deserve that is what I wonder. I mean, Bank of America is still a massive bank that has been doing just fine. Why are they trading just below book value in this environment? Are people really that worried? You know, I'll be going through all the banks and being ready to set up the competitive pressures against each of them into next week. We do that really quickly for you. To show you not just how well everyone's doing, but how they're doing next to each other.
And that's what we love about it. It's all relative to one another. We so appreciate it. Ken and Sonali, thank you so much. Ken Leon over at CFRA, and of course our own Sonali Balsek. Shares at Bank of America, by the way, down about 1.6% today. This is Bloomberg Radio.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21. We do check markets all day long at Bloomberg. Stocks are trading mixed. The S&P now in the red at 4507. Little change, down less than 0.1%. Dow Industrials holding on to a 152-point gain, up by about 0.4%. Nasdaq is down 33 now, a drop there of 0.2%. The Russell 2000 index of small cap shares down by 1.1%. 10-year yield at 3.81% with a 2-year, 4.75%. Spot gold at $19.58 the ounce, down $2.50. West Texas Intermediate crude down 1.9%, $75.40 for a barrel of WTI. Stock market action subdued as traders cite consolidation after a rally that put the S&P 500 on track for its best week since March. For the week, the S&P 500 index now up by about 2.5%. Banks front and center today after earnings this morning from JP Morgan Chase, Citigroup, and Wells Fargo. Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets.
We did recently do a survey of all of our analysts heading into this reporting season, not just in the U.S., but across the globe. And we found that our financials team was really resolute in terms of their optimism. And maybe, a slightly more neutral, view from our regional banks team. But even there, when I told them I wanted to upgrade the sector, they said they thought this was going to be the right call. If we could sort of get past this quarter and we're looking on a 6 to 12 month view.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcast. JP Morgan Chase shares, they're up 0.5% after earnings. Citigroup down 3.4%. Wells Fargo fluctuating up by about 0.1%. State Street shares after earnings, they're down 11.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Masser, Matthew Miller, live in our Bloomberg Interactive Brokers studio on this Friday, and it's kind of been an interesting week. Like good for a lot of assets, like stocks, right? Crypto stocks we've seen rally. A lot of reasons why we saw Treasury yields back off a bunch.
Bonds have rallied like crazy this week.
Yeah.
Pushing yields down. So if you hold them already, that's good news.
Yeah, exactly. So we thought we just wanted to kind of go to it and sum up the week. We still have, about 36 minutes left in the trading day, but we've definitely seen some of the major trends. So let's get to it. We also saw the tech-heavy gauge, home to the likes of NVIDIA, Apple, and Microsoft, surging 42% year-to-date. So we've just seen a continued move and momentum, I feel like, in that space as well. So let's get to it. Joining us right now is Isabel Lee. She's on Zoom in New York City. She's Bloomberg News cross-asset reporter, and Bloomberg News global macro strategist Vince Signorella. He's with us on the phone in White Plains. Isabel, I want you to kick it off for us, kind of set the tone for the week overall.
So it's been a really interesting week because we're seeing an everything rally, like major indexes, tracking stocks, corporate bonds, treasuries, meme stocks, Bitcoin, as you mentioned, they're all up. We're really just seeing a cross-asset rally, which is very fitting because I'm a cross-asset reporter. But it's interesting, and most of the analysts I talked to are really just crediting it to the cooler than forecast inflation print. So this is obviously good news. The soft landing narrative is growing louder. Recession calls are growing a little bit softer, or if some people are telling me that they expect a recession, it's definitely going to be a mild one. So risk assets are really just, you can see optimism across the board, and it just really puts some of the bears kind of to shame, at least for this week, because as we know, each data point really just elicits a different reaction from Wall Street strategists.
So, but we've come pretty far, pretty fast. Vince Signorella, jump in here and tell us what you would do if you, had bought stocks, say the S&P at the beginning of the year, and you were looking at a 17% gain. Is it time to take some profits off the table?
I think some, yes. I think we could easily see a pullback of about 2.5% or so. Going into maybe this is what will probably be some sort of summer doldrums, some back and forth trading here and there. What I still do like is the bond market, and I think today is an opportunity with this sell-off. Pardon me. This sell-off is coming on sentiment numbers, and my rule is to trade off real data, not sentiment data. And this week we saw CPI and PPI come in lower than expected. So the real numbers fly in the face of sentiment numbers. And this bond sell-off, I think, is an opportunity for today going into next week.
That's interesting. So you're saying really what you care more about was the actual inflation data than the sentiment of just what people are feeling.
Yeah.
Okay. Isabel, I want to go back to you for a moment and just about the tech trade, because there is a story in the Bloomberg. I mentioned NASDAQ 100 up more than 40% year to date. It's ahead of where it was at this point in 1998 and 1999, when full year returns amounted to 82% and 100% respectively. It was kind of a bubblicious time. What are you hearing when it comes to the tech trade specifically? Especially today's an interesting day, right? With some not rebalancing, right, or rethinking when it comes to the NASDAQ 100. We should get some details on that.
It is the special rebalance.
It is
and
rebalance,
then we'll get some more details on that. But the tech trade has been interesting because obviously the frenzy around artificial intelligence is really what turbocharged the NASDAQ into its best first half of the year ever. But then a lot of the strategists I talked to are also saying, okay, but people are acting like the AI will change things overnight, but not really. And a colleague of mine, Lu Bang, wrote a story, and then it was about this hedge fund trader, and he was saying that it will take some time. So he thinks that the rally is past its prime already. And that's why now, even if the NASDAQ is up, we're seeing it pare back a little bit. But then to the point of the rebalance, it's just been immense, the rally we've seen. That's why there's this special rebalance, which is one of a kind, because the NASDAQ, the company itself, it's like this over-concentration kind of has got to stop. And that's why they're trying to curb the weight of the top 6 firms. Magnificent Seven, other people call it, but Meta is not included. And they're going to trim them because now the threshold is at least more than 50%, at least as of July 3. And at that point, it's not really an index investing anymore. It's more like stock picking.
All right. I don't know if Vince Signorella is like watching some comedy. I thought I heard a little bit of a chuckle. But Vince, you have seen a fair amount of market cycles, and you have seen another, tech boom, if you will. Many people say it's not like what we got ahead of the 2000 tech bubble, if you will, 2001. What do you make of the rebalancing and the move up that we continue to see in some of these mega caps? Particularly in the tech sector.
A lot of guys are talking about possibly the sell-off in tech today is due to that rebalance, and it's not a sell-off in a general sense. You take the data that we've been seeing: lower inflation, consumers are spending more. Everything seems to be positive. But when I look at tech, this is something I've been talking about since we rallied in October. It's like you're not going to get your next iPhone from the Campbell Soup Company. AI is going to be what the internet was to the universe. And while it may have gone a long way and it may seem overdone, it's still going to go a long way to go. It is where you're going to need to be if you want to see returns down in the future.
But you need to know which stocks to hold if you want to profit on it, right? I mean, Amazon, you might have known that it was going to be huge, but it had a tough time and took a while to recover.
Yeah, and the larger tech companies with all of their big balance sheets waiting to be purchasing up what is, I don't know that they're going to do what Meta did, is and try to reinvent it themselves, but they have the balance sheet to go out and look and scour, and are far more intelligent about this than I will ever be, and purchase up the companies that will be the next thing in AI. So I think they're going to win in the long run regardless, and you can rebalance all you want, but you're going to look at the Apples, the Googles, et cetera, of the world. They're going to come out on top of us.
Next week, we get a ton of earnings. We've got Tesla, J&J, Amex, IBM, Netflix, Goldman Sachs, of course, the rest of the banks, TSMC out of Asia. I mean, these are all things that certainly... What did I forget?
I was going to... Vince, do you care? I mean, you sort of glossed over earnings season for when we were talking about at the top.
No, I think earnings season is a big deal because the expectations are so low, they're almost likely to all beat. And that's what everyone was talking about, is will these companies meet or beat expectations? I think it's in the cards, and that's why I think this rally is going to continue.
But I always wonder then, are we stupid because we've been managed again in terms of earnings? You know what I mean?
I think we're always managed when it comes to earnings. When things start to go slow, all the analysts mark it down so that it's almost impossible to beat, and vice versa. I think when you look at analyst estimates of earnings, it's almost always a setup to win and to beat.
I wonder if there are not some analysts who say, like, you know what, damn it, I take pride in my job, and I'm not going to lower my estimates just so that the CEO likes me better at next year's annual meeting.
I agree, Isabel, right? It's just the case. I mean, I don't know.
But we've been talking about it for 20 years, so we know it's just a fact of life.
But it's become more. It's become more.
Did you see that? Did you see that Goldman story that they're actively downplaying their earnings so that they won't disappoint for the third straight time? And Vince is right. It's really all about expectations. Rarely is it about the absolute number. It's really more about, do we think that they did better or worse? And yes, maybe we are being managed.
You know, it's like you have that kid, you know, we all have kids, and like some are like straight A's, and then some like you manage your expectations. I don't know. I don't get it. Are we being stupid? Fundamentally, though, is about there's support for the market to go higher or lower or stay where we are.
If she knew that, she'd be in a different job.
If I knew that, I would have bought a brownstone. No, but honestly, it's a lot of the analysts are boosting their forecasts.
I know.
And so that's kind of fun to write, but also interesting, because what are they seeing? Are they just saying that so they don't get left behind, or are they seeing fundamentals change, or is it because all of their peers are just doing the same? But then that's a consensus, at least. Like now it's more vogue to be a bear, but bulls are more rampant, let's just say.
Vince, 10 seconds when everybody starts being yay, 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 it makes me want to run in the other direction.
Well, yeah, usually it does, but, you know, we're at the Fed, one more hike potentially, and we're done, and I think that's going to drive assets into the rest of this year when the Fed hits the pause button.
All right, guys, have a great weekend. Thanks for the wrap-up. So appreciate it. Bloomberg News cross-asset reporter Isabel Lee, and, of course, Bloomberg News global macro strategist Vince Signorella. Want to get to news?
Yeah, let's go to Dan Schwartzman right now. He's standing behind us in the Bloomberg 1130 newsroom. Dan?
Hey, Carol and Matt. A man has been taken into custody on New York's Long Island in connection with the Gilgo Beach murders. Rex Heuermann has been now charged by a grand jury of 6 counts of murder. Beginning back in December of 2010 till April of the next year, the bodies of 8 women, 1 man, and a toddler were discovered along a wooded stretch next to the beach. Suffolk County Executive Steve Bellone says they never stopped looking for the killer.
We have never stopped working on this case. There are police officers, Suffolk police officers, who started working on this case who have retired now. But their efforts, their dedication, it has never stopped.
Here's some details on the suspect. Heuermann is a married father of 2. He's an architect and owner of RH Consultants and Associates since 1994, lives on Long Island, works in Manhattan. Police say advanced communication and analytics were used to lead them to the suspect. The Biden administration says it'll forgive $39 billion in student debt. Bloomberg's Amy Morris from Washington.
The change will help more than 804,000 borrowers. It comes as the Biden administration is looking for alternatives to a $400 billion student loan forgiveness plan that the Supreme Court struck down in June. This new plan counts more payments toward a forgiveness program that kicks in when borrowers have made the equivalent of either 20 or 25 years worth of payments. The Education Department says it will start notifying eligible borrowers today. In Washington, I'm Amy Morris, Bloomberg Radio.
Thanks, Amy. Actors hitting the picket lines today after their union SAG-AFTRA announced the authorization of a strike yesterday when contract negotiations with the Alliance of Motion Picture and Television Producers broke down. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. We've got the Dow higher, the S&P, NASDAQ 100 index, and the Russell 2000. They are all lower, but let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are ending the week mostly in the red after a choppy session. The Dow is down 130 points. Dow is up 130 points. S&P lower by 5, with the NASDAQ dipping 45 points. The U.S. 10-year yield is at 3.82%, and small caps are down 1%. 8 of the 11 main S&P sectors are trading lower, with energy and communications providing the biggest drag, while health and consumer staples are the top performers. NASDAQ Biotechs are little changed. Transports are down 125 points. Semis are lower by 50, while the VIX is up 2%. Leaders in the Dow, United Health, Merck, and Coke, while Cisco, Chevron, and Intel are the worst performers. In a busy morning of earnings, JP Morgan posted its best quarter ever. Wells Fargo boosted its NII outlook, while Citi had mixed results. State Street is on pace for its worst day since March 2020 after underwhelming results, while United Health led a rally for peers after earnings eased cost fears. Leslie's plunged to a record low after slashing forecasts, leading fellow pool companies to tumble. Wrapping things up, AT&T fell to a 29-year low on concerns around lead cleanup costs. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey, and to hear live breaking news over your Bloomberg-type squawk. SQUAW on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. We've got about 17 and a half minutes left in the trading session, so getting ready to wrap up the Friday trade on this Bastille Day and wrap up the week. Stocks, as you just heard from Bailey, they are definitely off their best levels of the session. Slight gain on the Dow. But, Matt, if you look at the week overall, Dow's up 2.3%, 2.4% higher on the S&P 500, and we're looking at a 3.25% gain on the NASDAQ 100. This is a day you're like, yeah, I'm going to log on to my 401k app and check it out.
Hey, take a little bit off the table, right? As you're going into the weekend, no worries. Get a beach book that has nothing to do with the markets or reality.
Exactly.
I think there's a little bit of that going on. And as Vince Signorella said, a lot of this could be around the rebalancing.
Exactly. So something to keep in mind, because this is certainly a big deal. We'll get some details after the close on that. Nancy Tengler, though, back with us. So delighted. Chief Investment Officer of Laffer Tengler Investments. They're a boutique active manager, about $1 billion in assets under management. She joins us on Zoom in Lake Tahoe, Nevada. By the way, she's got a book. It'll soon be coming our way, The Women's Guide to Investing. Nancy, so nice to have you back. Stellar week for stocks. Let's start there. We feel like, though, a big part of the story this week was certainly the Treasury trade. But how do you see it?
Well, I think...
And thank you for wearing Barbie pink.
Yeah, I was going to just ask
really
Ari if we could get a triple box. Can we get a triple box?
Can we get a triple box?
I heard pink. Someone said pink.
Matt's got a pink shirt on, too.
So I think, there's a lot of people that are still catching up, investors, retail and institutional, this year. And I think you're just continuing to see money flows come in on any kind of pullback. We had a pullback in July, and so people were in the first week, and so people were kind of piling back in. Earnings have so far, day two, been okay, pretty good. And I think investors are going to use weakness as an opportunity to get into some of the names they missed out on, not just this year, but since the fall.
What do you think, Nancy, about the bank earnings that we saw? I noticed, by the way, I put up Bank America, Wells Fargo, Citi, Goldman Sachs, JP Morgan, Morgan Stanley. The three that reported this morning are those that are doing the best so far year to date anyway. So JP Morgan, Wells Fargo, and Citi, oddly.
Yeah, we own J.P. Morgan. That was our choice in the big mega banks, just because they have a great leadership team, so many levers to pull, and you saw that in the earnings report today, and they're dominant. I mean, it's a little ironic that after Dodd-Frank, the big banks just got bigger and bigger and bigger. I do think Jamie's right to point out that the regulatory promises that we're getting from the Fed are probably an overreach. The problems with the Silicon Valley Bank and Signature Bank failures were not under regulation. It was regulators asleep at the wheel and bad management teams. So I don't think that the mega bank should necessarily be penalized for that. And I think he was right to bring that up.
Are we near the end of the rate cycle, in your view?
Yes.
Yes. How soon? Another quarter point? Another 2?
Yeah, Carol, I think probably one face-saving hike. Inflation is coming down pretty dramatically, as we had argued it would. PPI was super encouraging in terms of coming in at 0.1%. And I think that, the market has learned that it can operate in an environment with higher interest rates. From 1990 to 2007, the 10-year averaged 5.3%, and PE on the S&P was 18 times. So if you back out the mega cap, the Magnificent Seven, whatever you want to call them, the PE on the S&P is still 16.5. I think the Fed should be done. I thought they should have been done in March, but no one called, so I didn't get to my 2 cents.
Fed, are you listening? Nancy's here for you. Nancy, wait, I just want to follow because I feel like a lot of people.
Then I have a question.
Okay, then
so
you
go
can.
ahead.
Because you wore a pink shirt for me today, I'm going to let you ask. But let me just quickly, Goldilocks, soft landing, everybody seems to be weighing in today. Is that a fair assessment?
Yeah, I think it's a little bit late. We were positioning our portfolios for this period in October. We were adding to tech and consumer discretionary. Now there's a lot of folks who said the tech trade was over are coming in and saying, buy tech or soft landing, and I think Ed Yardeni had it right. I'm not an economist, but he's talked about a rolling recession. I think that is what we got. Housing went first, goods, manufacturing went next. And that seems to be what we're getting. Will it be a soft landing? I mean, I don't think it matters. I think what the market is now focused on is we're closer to the end than the beginning, to your point about rate hikes. Earnings were not nearly as bad in the first quarter as analysts estimated. They had negative 7.5%, and they came in around 2 to 3 positive. So I think what people are realizing is this is an inflation-induced slowdown. It's not a credit crunch-induced slowdown, and that has a very different implication for equities and for the economy.
Well, my question.
That's brilliant. That's brilliant. Like, think about that.
Yes, I was thinking about that, and my concern is that we do have a credit crunch slowdown ahead of us. So does the effect of the 525, let's call it 550 because we know July's a lock, does the effect of 550 basis points of hikes hit us later this year or hit us next year? Because you're not an economist, I'm not an economist, but the economists always talk about long and variable lags. So are they still waiting in the pipeline?
Could be, Matt. I mean, I think one of the things that is so unique about this situation is that corporations were adding lines of credit, borrowing at much lower rates, and their balance sheets are in pretty good shape. So, I mean, excellent shape, frankly. It's probably going to hurt small businesses because they're the ones that have to go through the traditional lending process, and that's where the squeeze is going to come. I don't know if that's going to impact small caps or if it's just going to be below that level. But I think actually that the large multinationals, and that's where we fish, are going to benefit in the second half of the year from a very weak dollar and from the fact that they don't need to borrow at these rates. It's the federal government we should probably be worrying about because about half of the outstanding debt comes due in the next 1 to 3 years, and the average coupon on U.S. debt is about 1.8%. So that's where we may feel the hurt.
Real quickly, in 15 seconds, if you have new money to put to work, where do you put it? Real quickly.
We're adding to industrials. We have been, and we will continue to be. We're overweight consumer discretionary tech, so if it gets weak, step in both those, and then add to industrials.
All right. So appreciated, as always. Nancy Tengler joining us, Chief Investment Officer of Laffer Tengler Investments. Check out
Thanks, Nancy.
a book soon to come, The Women's Guide to Investing, on Zoom from Lake Tahoe, Nevada. And she wore pink.
I'm a big fan.
I know, we both are. All right, you're listening and watching Bloomberg Radio.
Company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Sources tell Bloomberg Western Digital and Tokyo-based Kioxia Holdings, after months of talks, aim to reach a merger agreement by August. Those sources say the deal would be structured as a tax-free spinoff of Western Digital's flash business, which would merge with Kioxia. Western Digital up by about 0.7%. American Airlines and JetBlue Airways will end their partnership in the Northeast next week after a judge ruled that the deal violates antitrust law. Today, we do have shares of JetBlue. They are trading a little changed and lower today. We do have shares of JetBlue right now at down by 3.8%. Bank shares are mixed after earnings this morning. J.P. Morgan higher, Citigroup, Wells Fargo lower. Allison Williams is a senior bank analyst for Bloomberg Intelligence, and she was interviewed this morning on Bloomberg Surveillance.
You know, the most interesting things that I'm seeing this quarter and what might set apart these banks from some of the regionals is the credit card business, and that is really helping the net interest income. You're seeing the guidance being raised across these banks. Citigroup has weaker fees, so they're guiding up on net interest income, but flattish revenue. But I'm not sure we're going to see that across all of the regionals that are reporting next week.
And you can hear more of that conversation on the Bloomberg Surveillance Podcast. You can download it wherever you get your podcasts. JP Morgan Chase shares up 0.5%. Those are our top company stories. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
When Tim comes back, I
Yes.
want him to bring in his Fender Stratocaster and play that awesome riff. That Bloomberg Business Week riff.
You think he does that?
Yeah, I think it's probably what he's doing at home. He's sitting around with his new
Perfecting
baby
it?
and
Yeah.
riffing on his Strat.
Sons on drums. Yeah, could be.
Are you going to talk about the $2 bill?
Can we do that?
Yes.
I kind of love this story. So 15 years ago, first of all, I couldn't even get my head around that. That's when Bear Stearns collapsed. I mean, we were all in it, living it, writing about it, reporting on it.
The scary thing to me is that that was 15 years ago.
That's what I just said.
Which means that, like, if time goes that fast, I'm about to be 50. That means I'm about to be 65.
It goes fast.
It
Matt.
feels like that was just a couple of years ago.
It sounds trite, but I say it over and over, especially when you start having kids. It's just like, just everything goes. Anyway, 15
I'm
years
gonna die
ago.
soon.
Stop that. All right, let's just get through this Friday, okay? And then we'll talk about that stuff next week. So 15 years ago, collapse of Bear Stearns. The night JP Morgan agreed to buy the bank for $2 a share, I remember it was like, whoa, what are you kidding me?
$2. I remember watching the headline go across the terminal.
We all thought it was like a typo.
Yeah.
We're like, $2? And then, you want to go into the story?
And then somebody taped a $2 bill to the revolving door of Bear Stearns. Not just like with a piece of Scotch tape, but with a giant, like, clear...
It's like packing tape.
Unmovable, super sticky Gorilla Glue piece of tape that it couldn't be, like, removed. And everybody was going in and out of the office seeing that $2 bill fly around. And at the time... you just assumed it was some angry employee of Bear Stearns because, of course, they were the people who held the most stock.
Right, and everything came out. And, Dealmaker first to publish the image. Gawker quickly followed.
If you remember Gawker, then you're our age.
Yeah, exactly. Welcome to our world. In reality, the prank was committed by three then 20-something-year-old friends and former Columbia University roommates who had no direct ties to the firm. One of them, Bartek Ringwelski, had been an analyst at UBS until 2007. Another one, Alex Davidov, went on to spend 4 years at Bridgewater. Their careers have been more focused on tech than Wall Street. What?
I just think it was a good prank, but it's
we were
kind
joking
of a bummer that they had
around.
nothing to do with Bear Stearns. They just thought it was a silly thing to do.
They said their goal was to get it into Deal Breaker. All right, we're going to talk markets beyond the bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, Radio, and Bloomberg Originals. Carol, interesting day here in the markets, really across the board here as we close out what has been a very volatile week.
Yeah, absolutely. A volatile week. Big moves, certainly on the equity side of things, on the treasury side of things. And I'm going to play with equities right now because
Moves
I'm thinking
up.
about...
Big moves one direction pretty much.
More than 2% gains, 2.25% gains on both the Dow and the S&P. And Matt, we're looking at what, 3.25% higher on the NASDAQ.
Yeah, so, I mean, it has been kind of a runaway bull all week long, and it doesn't really matter where you look. You had bonds soaring, you had equities soaring,
Crypto
you had
stocks.
Crypto soaring, not just stocks, but also the underlying. You had oil doing incredibly well, right? We saw more than $77 a barrel on NYMEX crude. Now, a little bit of that has reversed, but I think it's been just kind of a risk-on sentiment, buy everything rally all week long until today.
Yeah, I mean, you still have some things up. I mean, home builders hitting another record high pretty much across the board here. Obviously, healthcare stocks doing well on the back of those United Health earnings. But then there was a lot of talk, I guess, what happened with some of the, media companies, you know, the Disneys and Warner Brothers and Paramounts on the back of that actors strike that started this week as well.
Actors strike and Bob Iger can't think of anything to do with the company but stay there, right?
Or the board can't think of anything to do, and so they asked Bob Iger to stay there.
Good point.
We get the closing bells here in New York. A mixed day here, though we should point out that the narrative, at least for U.S. equities, is the same on a weekly basis, and that is another week of gains across the board. As for today, the Dow Jones Industrial Average is the only major index to finish the day in the green, up about 0.3%, or roughly 100 points. The S&P 500 holding that 4,500 level, but down about 4 points on the day, or about 0.1%. The NASDAQ Composite down 0.2%, and the Russell 2000 going to close out the day lower by 1%.
All right, and Romain, most names in the S&P 500 actually lower today, about 328, 174 to the upside. If I look at the week overall, though, Matt, your best performing name in the S&P 500 was Match Group, up almost 14%. At the bottom of the pack is Progressive, down about 11%. That's the week overall.
It's been like 20 years since I went on an internet date. And I did use Match.com for a couple of those. They were unsuccessful. Take a look at the movers here. The group rank returns show you that there were some winners, Romain, as you said. And healthcare, which has been a loser all week, was one of the groups, or the biggest group in the green, up 1.5%. Otherwise, consumer staples, consumer discretionary were up a little bit, but everything else, as you know, we saw consumer sentiment up, but everything else was down, led down hard by energy and then financials.
All right, guys, let's get to some of the individual gainers in today's session. I want to start with United Health. Yep, we focused on big banks, understandably so, but check out United Health also reporting earnings. This stock finishing just off its highs of the session, still about a 7.25% gain for the Friday trade. Number one gainer in the S&P 500. I think it's up the most since about November 2020, so quite a move to the upside. This company, it's massive, $445 billion market cap. And what the company did come out, second quarter profit beat, raised the bottom end of its annual profit forecast, so allayed some of the concerns that Wall Street had when it comes to runaway medical costs, and it really lifted that whole space here. Elevance Health benefited by what United Health said. This was number two gainer in the S&P 500, a gain of 5%. It does report next week. Want to mention Copart. It hit a record today, top of the NASDAQ 100. Ticker is CPRT. That stock finishing with about a 3% gain. $44 billion market cap company. It basically does auctions of salvaged vehicles, sells them to insurance companies, vehicle suppliers. Stock is up more than 50% year to date, so I thought that was interesting. Last but not least, Tesla, it has tapped the ABS market for the first time since its credit was upgraded to investment grade back in March, and that one actually an outperformer up. Matt? 1.25%, or actually, Scarlett, I think you're going to take it.
Yeah, let me take a look at some of the big banks here, because of the big money center banks that did report, Citi was a big laggard here. Net profit falling 36% because of flat revenue and increased severance costs versus at least 57% net profit gains at JP Morgan and Wells Fargo. So analysts said Citi's results were less impressive than peers. State Street was the worst performer in the S&P 500, down 12%. Revenue and net interest income came in weaker than expected. It was mainly a lower tax rate and smaller loan loss provision that helped EPS top the analyst estimates. So as a result, a lot of people are saying the results were low quality beats. And AT&T has not risen any day this week. We talk about a big week for equities, not for AT&T. And today's volume was more than double the 3-month daily average after JP Morgan downgraded it from overweight on concerns of potential liability from the toxic lead wiring throughout parts of its nationwide network. And finally, here's a group of stocks that we don't talk about very much. The swimming pool industry, pool down almost 5% after Leslie's, a pool supplies retailer, slashed its annual forecast following a decline in customer traffic.
I'm actually really into this story because we actually did talk a lot about Pool Corp and some of those stocks a couple of years ago when they were all rallying because everybody was stuck at home and was trying to buy pools or do other things. And then that downdraft that we saw in Leslie's today, I mean, just absolutely astonishing. I think it was like a 30% drop or something.
Everyone went to Europe, apparently.
Went to your peer. Yeah, 30% drop. Well, worst day for that company since it went public back in 2020. Maybe that is a read on some of the consumer durable spending. I do want to take a quick check, guys, here, what we saw in the Treasury space, because that was wild, to say the least, to hear. We talk about, I think it was Wednesday, right? We had a big 12 basis point drop in the 2-year yield. Thursday, we had another 12 basis point drop in the 2-year yield. And today, for some reason, we're erasing that. Now up 12 basis points, 13 basis points. And that's on the back of economic data that maybe seems to suggest that the inflation story is far from over. This was also pretty lopsided as well. You can see that on your screen there, with most of the selling coming in here on the 2-year, on the shorter end of the curve here. So that's basically now re-steepening the curve overall.
You look at a 5-year chart of the 5-day chart, I should say, of the 2-year yield, and the high was 4.95%, the low was 4.6%. It's just this massive swing over the last 5 days.
And all of this because of the University of Michigan. This is all on expectations, right? Because 1-year expectations were 3.4% instead of 3.1%, and because confidence was so high, I don't think that necessarily means inflation has to rear its ugly head again, but it's definitely got to be a concern for the Fed.
But isn't this kind of what some people were saying? And, some of the contrarians were saying, okay, after we got the CPI report that, you go back to the Volcker era, it was sort of like, oh, they had won the fight against inflation, and then you had that big resurgence. And then, of course, Volcker had to really just come in and lay the hammer down. And there does seem to be that fear that we could see some sort of a repeat of that.
Hence the starts and stops, if you will, right? We see it in the trade and the big swings that we see in a big way. So I don't know. I'm starting to think about what we get next week, Matt. We've got a bunch of earnings from some really well-known companies, more of the big banks. We're going to hear from Netflix. We're going to hear from major players. We're going to hear from Tesla, IBM, right? JJ, Amex. So I think about what we're going to get from them and how that may be some of the fundamental news, actual news in terms of outlooks and some of the numbers, how that maybe that takes more priority over some of the Fed speak and some of the economic data points.
Yeah, I mean, you hope so, but I mean, I feel like at some point it will all be about like, oh my gosh, what did whatever FOMC members say today?
Just wait for a big retail sales number to come in and change everything, right?
That's true.
Yeah, absolutely. But I mean, but this gets to the question. I mean, everybody is trying to basically be the Fed, right? Basically trying to read the economic data before the Fed gets to it and figure out where they go next.
Everyone's trying to outsmart everyone and get ahead of it, and you could get ahead of it and look at the 2-year yield and get stung by it.
It's sort of like how Carol and Matt came in Pink today, not realizing that Barbie movie isn't until
next
week.
We thought it was. That's fair. We did think that this weekend was the start of the Barbie movie, which is why we wore pink. And I came in this morning only to find that we were wrong. I was deceived.
Well, I'm just glad you did.
To debut the new issue of Bloomberg Business Week.
You know what? We're doing the marketing for the film stars because they can't do any marketing right now. They're on strike, right? So now we're talking about the film on their behalf.
I believe in celebrating.
What I want to know is
maybe they'll come on the show next week.
Why didn't you just wear black for Oppenheimer? What is this?
Black or gray? I think
or
gray.
Gray for Oppenheimer. Yeah, it's a very dark movie.
Because
some shade of gray.
Because we're all about light and levity. Did you know that?
We cover the markets.
Who are you talking about?
I don't know. I don't know who I'm talking about.
Did you
but
replace?
it'll be interesting to see the box office, just in general. Is Oppenheimer opening this week?
No, they're both opening next week.
Barbie Oppenheimer.
They're both opening next week, Carol. A lot of people are going to both. On the same day.
You know why they're both opening at the same time?
No, why?
Sorry,
apparently because Christopher Nolan left the studio that was making Barbie. He wasn't gonna make Barbie, but he was working for that studio.
He was ticked off because the studio released stuff straight to streaming, and he didn't like that.
So he went and made Oppenheimer, and then the studio said, "We'll release Barbie on the same weekend out of spite." That's the rumor.
It's all boys in a sandbox.
Yeah.
That's what it comes down to.
You doing anything this weekend? Okay.
I'm not watching either of those movies because they're not out.
Oh, by the way,
I love Carol and Matt here. It's like a married couple here. They're just finishing each other's story.
Romaine, did you see Scarlett even has like a peachy pink on?
I know. I feel like that.
You have such great color.
I was going to tell you before, by the way, that one time I've worn I had a pink jacket I wore on air. And
when did you?
Our boss, our former boss, took a little bit offense with the stylistic choice, and now I just dress in drab grays and blues.
Now he's dressed for Oppenheimer.
But now I'm going to go look in my closet and try and find that.
Next Friday. I still have a pink dress. We're going to be on it. All right, guys, that's a wrap. Have a great weekend.
You too.
That is a wrap for our cross-platform coverage on TV, on radio, on YouTube, Beyond the Bell. We will see you again on Monday. labor stoppage. For the first time in 6 decades, Matt, you've got writers in Hollywood and actors striking at the same time. Not good for anybody.
True, I guess.
Well,
right?
I don't know. It's not good when you have a work stoppage.
They must think that they need to do it, which is
Right.
why they are. I have seen Fran Drescher all over the place over the last couple of days saying she's worried that, I guess, AI is going to take their jobs.
Well, this is what we've got to get to. There's also a Bloomberg exclusive we want to get into about a possible deal to take over CAA, Creative Artists Agency. A lot going on. That exclusive, by the way, by our Cameron Leach and Lucas Shaw. So joining us for Hollywood Roundup is Bloomberg News entertainment editor Chris Palmieri on Zoom in L.A. and Lucas Shaw, entertainment reporter at Bloomberg News, on the phone from Boston. Lucas, kick it off for us. The strike, not a good thing.
The people working in the industry feel the need to strike, and there are reasons why the studios don't want to reach a deal. But having a long-term labor stoppage isn't good for anyone. It puts thousands of people out of work, and longer term, I think it's going to lead to people turning to other sources of entertainment. And come next year will mean that we'll probably have a lot less to watch.
I mean, it seems like people are already turning to other sources of entertainment. If you look at the box office take, there haven't been any real smash hits. I guess Mario Brothers is a model in that it did well, which I can't understand. Who in the hell would want to go anyway? Chris Palmieri, what's wrong with Hollywood right now?
By the way, I can tell you a little funny story about Mario. My wife was wearing a Mario hat, didn't even say anything when we were on vacation last week. 5 people said, "Great hat." That's the appeal of
I must
Mario.
have different tastes than everybody else in America, because I loved the game, when I was a kid, but I don't need to see a cartoon movie about it with, anyway.
It's big. You might not be the right demographic. Here in LA, people are marching in the streets. This is the first day where the actors hit the picket lines officially with the writers. The writers have been on strike since May. It's even more colorful when the actors become involved. They had a bus, Fran Drescher's, going from studio to march. I suspect it will be even more colorful as the days progress.
Right. We saw also actors for Oppenheimer, right, do the red carpet but not go to the premiere in support of those who are striking. Lucas, what's the issue? What are the issues, and are they valid?
Well, the biggest issue, or the common denominator behind most of this, is money. Obviously, this is a labor negotiation. The details can get a little complicated, but they boil down to things like minimum salaries for both writers and for actors on projects. That's, of course, not the salary that Brad Pitt and his agent negotiate, but instead what the journeyman actor gets. There's residuals, which is what you get paid for repeat viewings and reruns. That's a big issue both domestically and overseas. There's a desire on the part of both writers and actors to get paid more in success, sort of get a piece of that upside, which is something that doesn't really exist in the traditional sense in the streaming business. And then there's the wild card in all of this, which is artificial intelligence and a desire on the part of both writers and actors to be protected against their work being used to train models or being replaced by robots. And it's unclear, how real that concern is, but the studios have certainly done nothing to sort of disabuse them of those concerns.
So the interesting part about that is, Lucas, that they could be used to train models. Is that already happening, or is that just a fear?
Well, it's happening a little bit in the sense that, or I should say, artificial intelligence is already being used in Hollywood for visual effects, for example. You can imagine how much cheaper and easier it is for a company to sort of digitally create a big crowd instead of hiring hundreds or thousands of extras. And there are some models that either legally or illegally have been trained on people. Say there was the big Drake, The Weeknd song that scared a lot of people in the music business. There's a movie coming out later this year that Robert Zemeckis directed that stars Tom Hanks, in which Tom Hanks will appear at sort of multiple ages. And that's because they've used artificial intelligence to effectively de-age him, which is something we've seen. Princess Leia, when she showed up in a Star Wars movie, there was some artificial intelligence involved in that.
Right.
But there is this broader concern that people are going to train models on thousands of actors, and this is going to reduce the amount of work that they have to do on set.
I mean, Chris, I would say technology is a growing part of Hollywood for years, decades. I mean, take a look at the first Star Wars versus versus Avatar, or versus a newer Star Wars today, if you will. So I don't know. It's going to be a mix, won't it, ultimately?
Yeah, well, to Lucas's point, if you look at the new Indiana Jones, probably a quarter of the movie is a de-aged Harrison Ford. Difference, I think, is that he was getting paid for that. One of the nuggets that came out of the press conference that the Screen Actors did yesterday was they said, well, one of the proposals that the studios made is that we'll pay a background actor for just one day's work. We'll scan their image, and then we'll have the rights to that, to replicate the image in the movie in perpetuity. So the Actors Guild said, well, that's just not acceptable. So these are the issues they're going to have to work out.
Let's talk about CAA.
An exclusive.
Yeah, and Selma Hayek's husband, who's very wealthy, he's some sort of Pinot. He wants to buy it for $7 billion, Lucas?
That is what we heard this week. You talk to folks in and around the entertainment business, and they think that price seems very high. When CAA acquired the smaller talent agency ICM just a couple of years ago, the value of the company was estimated at more around $5 billion. That's, of course, all sort of what they're saying. There's no public marker for that. And it's not clear why the valuation of the company would have gone up $2 billion since then, especially given the labor unrest and uncertainty that we're talking about here today. But look, you can never account for what a rich outsider, especially someone married to a famous actress, wants to pay to own the biggest talent agency in Hollywood. And CAA has been owned or majority controlled by TPG, which has been invested in the firm in one way or another for more than a decade. And there are a lot of people who'd like to get their money out, both people at TPG and people who work for CAA.
Chris, you want to weigh in on this? What's your thoughts?
Well, I would also just note there's been a lot of turmoil in the talent agency business, a lot of investment, there have been mergers, and then in reaction to the strike, a lot of layoffs, furloughs, people taking pay cuts, slashing spending on travel and lunches. And so, I wouldn't be surprised if we see more changes in the business.
Lucas, 30 seconds. It's not about maybe an agent, I don't know, a vehicle for...
We want to know if he's buying it just because Selma Hayek's his wife. I mean, is he just mad that she did that movie with Owen Wilson? She needs to do better stuff.
I don't think, look, he's rich, but I don't think he's so rich that he's just doing it because of his wife.
All right. I think my takeaway is that he can get a much better price than $7 billion, especially if everybody goes on strike. If it's longer, the price drops further.
Hey, real quickly, Chris, Barbie, it's going to be a runaway hit? 10 seconds?
Yeah, boy, it sure looks that way. Everybody's talking about it. Everybody's wearing pink.
We are. Lucas, going to be a runaway hit?
Definitely.
Okay.
Lucas is going. I know his girlfriend wants him to take her.
Who doesn't want to go?
Or she will take him, maybe, is the better way to put it.
I like that. I like that. All right, guys, thank you so much. Have a great weekend. Bloomberg News entertainment editor Chris Palmieri on Zoom from our LA bureau. Thank you. Lucas Shaw, entertainment reporter at Bloomberg News, on the phone from Boston. Read more about his exclusive.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 421 on Wall Street. We do check markets all day long at Bloomberg. It turned out to be an up week with the S&P advancing 2.4% this week. It is on to the weekend. It was a mixed Friday, though. We had the Dow higher, up by about 0.3%, up by about 113 points. S&P 500 index down 4, down by 0.1%. NASDAQ today finished 0.2% lower, down 24 points to 14,113. 10-year yield 3.82% with a 2-year 4.76%. Gold down $5 the ounce to $19.55, and West Texas Intermediate crude was down 2.2%, $75.23 a barrel. So the S&P heads into the weekend at 45.05. Swimming pool stocks took a dive today after pool suppliers retailer Leslie's slashed its annual forecast following a decline in customer traffic. Shares in the Phoenix-based company plunged 29.6% today. Among peers, Hayward Holdings down 7.9%. Pool Corp, it uses the ticker POOL, it was down 4.9%, and Latham Group, that uses the ticker SWIM, it was down by 7%. Again, recapping, stocks ended the day mixed. The Dow higher, S&P, NASDAQ both lower. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So Matt and I have been talking about it. Shares of companies with exposure to crypto surging this week. Investors cheering a key ruling on one token as a win for the industry. Our Bloomberg Intelligence team writing that yesterday's court ruling in the SEC versus Ripple is a solid win for the crypto industry, and assuming affirmance on appeal will limit the SEC's regulatory reach over the space. Now, the ruling that the Ripple token is a security when sold to institutional investors, but not the general public, added to optimism over Bitcoin ETF applications. A lot going on. Ripple Labs CEO Brad Garlinghouse spoke about the ruling with Matt Miller on Bloomberg Markets.
The SEC clearly lost as a matter of law, and the judge wrote, XRP is not a security as a kind of intrinsic thing. In certain circumstances, which is kind of a narrow definition around institutional sales, it could be a security. This is a win for Ripple. It's also a win for the entire crypto industry, and I think that's why you saw the crypto industry react so positively over the last 24 hours.
Yeah, he seemed a little happy. All right, so let's get to it.
He was pumped. He was mad at me first because I said it could have been viewed as a win for the SEC, because they did rule that XRP was a security when Ripple sold it to institutional investors with essentially a business plan. Like, hey guys, here's this currency and here's a business plan, and you're gonna all make tons of money when we get in this business together, which is what a security is.
All right, so this is why we wanted to talk about it. In our weekly look at the world of crypto, great to have with us Bloomberg News Managing Editor for Crypto, Stacey Marie Ishmael. She is here in our studio, along with Alex Edelman, co-founder and CEO of Lolly. It's a Bitcoin and cash back reward site, an app and browser extension, and basically you shop at more than 25,000 stores and you earn rewards. All right, so let's get to it. Stacey, I want to kick it off with you. Win? Not win that ruling yesterday? I mean, investors seem to see it as a win.
I would certainly not be as definitive in declaring this a win for Ripple or a setback for the SEC as some of the more, shall we say, enthusiastic crypto folks have been over the past couple of days. Everyone that we've spoken to, especially in the past 12 hours when I think people slept on it a little bit, have said, there's parts of this, to your point, Matt, that really seem like unambiguously a victory for Ripple thus far in terms of the SEC finding, for example, that sales to retail investors, or what they called programmatic investors in this ruling, completely fine, not considered a security. But one thing that we like to emphasize, because we're news editors and this is what we do, is this case is far from over, right? There are going to be more rounds of this. This ruling may be completely upended. And so while there's a lot of enthusiasm right now, we just don't know if it has legs.
Shocking, more litigation on this one.
And, well, we've seen a couple of regulators get defeated in court this week, and they're both going to go back for more. Alex, what does this mean for the broader industry? This has been a case that's been hanging over crypto for so long. I don't even like to talk about it because people are so emotional about it on social media. I'll get attacked if I go one way or the other. But now it seems like we have at least a little bit of an answer.
Yep. we've been in this gray area for a very, very long time, and so many companies, so many exchanges have been waiting on this answer. And so, what we as builders in the crypto industry, the hardest thing about building is the gray area, and the SEC has not taken a hard stance on anything. And this XRP case is one of the first cases where they're actually taking a favorable stance, or the court case took a favorable stance for the entire crypto industry. So I think it's very bullish. I think the market's reflecting that.
I think it's a little bit challenging to say the SEC hasn't taken a hard stance on anything when it's, we're in like the double digits of enforcement actions. We now have multiple filings in which Gensler and others from the regulator have said, hey, here's a very specific list of things we consider very specifically to be securities. So what we have often said is the industry is getting clarity about what the SEC does and does not like, but is not necessarily fond of the answers that they're getting from the regulators.
We have heard, I talked to Tim Draper a couple of days ago, and he was very adamant about the fact that regulation through enforcement is not the way he would like to see it happen. And Brad Gerlinghouse today said the same thing. He said, regulation through enforcement is the wrong way to do it. And they, these are obviously very pro-crypto people, but they all say this is going to hurt our national interests because other countries are doing it better. How do you see it, Alex?
Absolutely. We're falling behind Hong Kong, Europe, UK specifically, in Japan, all making pro-crypto legislation, regulation that is very favorable for the industry. And so, when I talk to other founders, CEOs, they're like, why am I building here in the US when, the SEC and Gensler can't make up their mind about what they want to do? And so people are just going to go elsewhere. We live in a free market. I can access the internet anywhere. Why would I start a company in the US? So the more that becomes part of the sentiment of builders, we're just going to lose jobs, we're going to lose innovation, and we're going to lose this entire industry.
How is this impacting you? How is this impacting you specifically? Kind of the uncertainty or yeah.
We're a Bitcoin only and Bitcoin focused company, so we've always taken that stance of Bitcoin. Everything Gensler has ever said has been very favorable for Bitcoin. For other things like Ethereum, XRP, Solana, that's the gray area that I'm referring to, where they really haven't taken a hard stance. And so I'm very patriotic. I love America. I want to build here, born and raised here. And so I want to stay here as long as possible. But when I look at expanding the company, it makes very little sense to build in an area where that's not favorable, is not welcoming to me and my company, and other companies too. So, part of the space is about, you want to sort of get in the lane of the free market and have your company grow organically. When you're geographically constrained, it's very hard to build a company when everyone else has a market of 4 billion people with internet connection and I only have a market of 300 million people in the US. It becomes very difficult. So I think people are just going to keep going elsewhere unless the SEC, unless the government, this administration takes a more favorable stance on crypto.
This is a threat that multiple industries have kind of waved at regulators for a long time, and I certainly think one of the interesting things about the SEC is they just straight up do not seem fussed. They across the SEC, the CFTC, other folks, when crypto CEOs go on Twitter and say we'll take our business elsewhere, they seem to be like, okay, and here's another enforcement action on a Thursday. So this doesn't seem to have been a particularly persuasive set of arguments. I also want to note in jurisdictions like Hong Kong, one of the reasons that FTX left Hong Kong and re-domiciled in the Bahamas is because China and Hong Kong and other countries have had very inconsistent approaches to crypto. Like they've gone back and forth on this is allowed or we'll throw you in jail in kind of under 2 years at a time. So it certainly isn't the case that every international jurisdiction is like hard and fast on being welcoming at all times.
I think that's an excellent point, and I totally agree. I think where the exchanges and the companies that are going to build the most trust are going to be domiciled in places that take favorable, clear stances and do have some form of regulation. Otherwise, we wind up with more FTXs, more Mt. Goxes, and so.
But don't investors want it also in either a developed market or a market? We talk about rule of law and different things. Like, as an investor, I'm not going to play maybe in a market where I'm a little nervous about how things might play out.
This is an actual, to me, I think one of the most interesting challenges about this offshore conversation is that, you could have invested in crypto if you wanted in 2013. Would you have been able to do that in a U.S. regulated exchange that you were fairly confident wasn't going to be like two brothers who would steal your money and disappear. It was a very different thing, right? And so to your point, a lot of people who were willing to take the advice of celebrities saying buy Bitcoin, buy NFTs were able to do so because there were, there's Coinbase, there's a US listed, publicly traded, highly regulated entity that folks feel comfortable with. That's a very different thing from somebody saying like, here's a website that will let you do anything you want, but you don't know where they are.
Use a VPN.
Yeah, exactly.
Don't worry. Do you worry at all, Alex? We've only got like 30 seconds here, but about Bitcoin price manipulation. That's one of the concerns I've heard a lot of people voice when we talk about the possibility of an ETF.
I don't know. I think institutions coming in are good for Bitcoin in general. I think there are some people in the camp that say that BlackRock and Fidelity getting into it are bad, but I actually think it makes it more accessible to everyone. To a point that you brought up earlier, I think that every single one of these hacks is teaching people to hold their own keys, and not your keys, not your coin has always been since I've been in the space since 2013, has always been the sentiment, and that's how you protect your Bitcoin. That's how you protect all your crypto. So the more that people learn that, even if they have to learn it the hard way, the better.
5 seconds, Stacey. We still got a ways to go here.
Not your keys, not your coins is really technically complicated.
These guys. Stacey Marie Ishmael, managing editor for crypto at Bloomberg. Alex Edelman, CEO at Lolly. Thank you so much.
Let's get a check right now on world national news. For that, we go to Dan Schwartzman in the 1130 newsroom here in New York.
Thanks, Matt and Carol. A man has been taken into custody on New York's Long Island in connection with the Gilgo Beach murders. Rex Hoyerdman has been charged by a grand jury of 6 counts of murder and has been remanded without bail. Hoyerdman pled not guilty to the charges through his attorney. Will next have a court date on August 1st. Beginning in December of 2010 till April of the next year, the bodies of 8 women, 1 man, and a toddler were discovered along a wooded stretch next to the beach. Hoyerdman is a married father of 2 who is an architect and owner of RH Consultants and Associates since 1994 and lives on Long Island while working in Manhattan. Police say advanced communication analytics were used to lead them to the suspect. House Republicans have added culture war amendments to the National Defense Authorization Act, putting the defense policy legislation in jeopardy. Bloomberg's Amy Morris reports from Washington.
The House voted to add provisions that would block the Defense Department from paying for or reimbursing expenses related to abortion services. It would stop health insurance for military families from covering treatments or surgeries for transgender individuals. It would curtail diversity, equality, and inclusion initiatives and block Defense Department school funding from being used to promote race-based theories. The amendments put passage of the entire $886 billion bill at risk. In Washington, I'm Amy Morris, Bloomberg Radio.
Thanks, Amy. Temperatures expected to reach dangerous levels over the weekend in parts of the West. Around 100 heat records could fall just this weekend. That's adding to the more than 1,000 records that have already been broken. Check this out. 90 million people are currently living under heat alerts. Areas seeing temperatures well over 100 degrees. California's Death Valley expected to reach 130 degrees on Sunday, while Las Vegas could get as high as 117 degrees this weekend. Phoenix, by the way, is setting records in terms of consecutive days with heat over 90 degrees. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. Stocks posted mild losses as traders cited consolidation after a rally that still drove the S&P 500 to its best week since mid-June. Now, on the week, we had the S&P up just about 2.5%. Today, however, ended up being a down Friday. S&P ends the week, heads into the weekend at 45.05, a drop today of just about 0.1%. The Dow, however, held on to a 113-point gain, up by about 0.3%. United Healthcare helping drive those gains. That stock, by the way, up today by 7.2%. NASDAQ was down 24 points, a drop there of 0.2%. 10-year yield 3.82%, with a 2-year at 4.76%. Spot gold $19.55 the ounce, down $5 the ounce today, a drop of about 0.3%. West Texas Intermediate crude down 2.1%, 75.26 a barrel. Well, as for the overall market backdrop, Nancy Tengler is Chief Investment Officer at Laffer Tengler Investments, and she was our guest right here on Bloomberg Business Week.
I think you're just continuing to see money flows come in on any kind of pullback. We had a pullback in July, and so people were in the first week, and so people were kind of piling back in. Earnings have so far, day two, been okay, pretty good. And I think investors are going to use weakness as an opportunity to get into some of the names they missed out on, not just this year, but since the fall.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. AT&T shares are at an almost 3-decade low amid growing concerns about the potentially high costs that the phone giant will face if it has to clean up contamination due to lead-clad wiring throughout parts of its nationwide network. AT&T shares today down 4.1% to $14.50. Recapping stocks end of the week, end of the day mixed. S&P down 4 points, drop there of just about 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that update. Carol Masser, along with Matt Miller, live on Bloomberg Business Week in our Interactive Broker studio on YouTube and, of course, on our streaming service, Bloomberg Originals. So, Matt, I was coming across, just reading in for this, lawmakers continuing to really tussle over Republican claims that ESG is a way to push progressive policies that don't prioritize financial metrics for investors. And then you have Democrats saying ESG spotlights essential data and issues such as climate change or workplace diversity that helps investors understand a broad range of material corporate risks. So the battle continues. And
wait, you Republicans and Democrats don't agree?
They don't. But I'm just thinking about the corporate community has to kind of, figure out, all right, what do we do with this political backdrop?
I think probably everybody on both sides of the aisle cares about planet Earth. Right? So the problem is when you label it ESG or DEI, then it becomes a political football. Just drop that and do things that are good.
Just do the
As
right
Google
thing.
said, don't be evil.
Just do the right thing. All right. Well, let's get to a company. It is one of the world's biggest beverage companies, the Coca-Cola Company. Let's see what they are up to and how they are putting all of this to work. Kurt Ritter is VP and General Manager, Sustainability of North America at the Coca-Cola Company, with us on Zoom in Minneapolis, Minnesota. Kurt, good to have you here on this Friday. It's an interesting backdrop that we have, and you, among other companies, have to just kind of figure it all out. Tell us about what you guys continue to do when it comes to ESG and what that means to the company. And do you agree with kind of Matt? Let's just get rid of it and let's just...
Yeah, do you like the acronym ESG, or do you tend to drop that from your title?
Well, first of all, it's great to be with both of you, Carol and Matt. So thanks for having me on your show. And as you alluded to, I lead sustainability for the Coca-Cola Company in North America, which really for us is, honestly, we're guided by a very simple purpose as a company, and that's to refresh the world and make a difference. And what we believe very strongly is the world has a waste crisis, and there's no doubt about that, as you said, Carol. And we have to be a solution to that crisis. We have packaging that we put in the market that we believe is highly circular, right? So for us, we have an ambition that we call World Without Waste. And that's a program where we're trying to drive a circular economy on our packaging and recycle more of our packaging and use more recycled content in our packaging, because it works, and we're on a journey to achieve that. So whatever you call that may be, but for us, it's important, right? Because it's at the end of the day making sure we leave the world in a better place.
So the wrangling that goes on, the Supreme Court, like when it comes to diversity and inclusion, do you guys just say, all right, we're going to still continue on with what we want to do in terms of our impact on the environment, in terms of having a diverse workplace? You just keep moving ahead.
Well, for us, it's for me personally, it's all about how we operationalize sustainability, Carol. I mean, we have a bold ambition around some goals we've set forth for ourselves, and that's by 2030, and that's coming up. And those are related to our packaging. We want to collect and recycle a bottle of can for everyone that we sell. That's a tall task, but one that we're making progress towards, and making sure our packaging has more recycled material. Those things all takes time. It takes collaboration, but that's what my team and I'm focused on.
Can I ask you, why does it always take time? Matt and I will hear these projections, and it's like 2030 or 2050, and I'm like, we're all going to be dead by then, because we see what happens. We saw it in New York. We see it in terms of the temperatures and the rises in temperature, the polluted air because of wildfires in some other part of the globe. It's happening. We're living in it. So I get a little nervous about the clock ticking and really how much time we have to get it right.
Right. No, and I think there's a lot of us that agree with that. We need to make sure it takes less time, right? And that means that we have to do things faster and with more sort of swift investments. In fact, we just launched something last couple of days that we announced that we believe will help us move faster, Carol. You may have read we joined with our top 8 bottlers around the world, so the Coca-Cola bottlers that make, produce, and sell all our products together with us, and a venture capital firm named Greycroft. And that's really an effort for us to move faster and invest in innovative technology and startup around decarbonization, around packaging efficiencies that can help us move faster, because there's a lot of great ideas and innovations out there in the marketplace. Sometimes it takes time to find that. So that initiative in by itself is one of those where we think we can actually allow ourselves to move faster by finding the right investments and into the right innovations to have more progress, more fast.
One thing I wonder is, does it hurt you when you see waste floating in the ocean, trash covering Indonesia, and there are so many plastic bottles among that waste? I mean, a lot of them obviously from your company. Have you thought about just not making plastic anymore? Aren't aluminum and glass better ways forward?
Well, Matt, of course it hurts, right? You don't want to see trash anywhere. You want to see it in your backyard. You want to see it in the ocean. You want to see it on the streets. I mean, there's a circular economy that's there for plastic, aluminum, and glass, by the way. And what you've seen, I'm hoping you've seen it, is for us, one big proof point that we're trying to really truly educate consumers around recycling, Matt, is the fact that if you look at some of our Dasani water bottles, even our Coca-Cola bottles today in the U.S. are starting to have 100% recycled plastic inside of those bottles. So that means we're making the bottles from 100% recycled materials.
But why don't you just get rid of plastic and just do aluminum and glass? Because those don't have such bad effects on.
Well, the point is plastic stays with us forever. Yeah.
And we can recycle plastic, so that's what we're focused on. I think there's other materials like aluminum and glass that we have as well. And we're also looking at, glass has a really unique opportunity, as you've seen in many markets, around being a refillable bottle. So we are working and looking at how can we just do more refillable and reusable packaging, right? And that's something that we're trying to also grow faster.
Hey, Kurt, before you go, 30 seconds, Greycroft, just tell us about this fund that you guys are doing, because this is really interesting, and just quickly, unfortunately.
Yeah, no, of course. So it's really for us, we have an incredible supply chain, Carol, around the world that our bottlers make up. So what this fund is meant to do is allow access through the investments that the fund that we will make into startup technologies, startup innovating companies, get access to our system so we can use and leverage our system, our supply chains for those companies to really experiment, pilot, test, and learn things that can help us decarbonize our footprint, get a better packaging portfolio, and again, move faster like we talked about.
Well, so appreciate you weighing in. We know it's companies are trying to work on it, and there's a lot of moving parts. Kurt Ritter, VP and General Manager, Sustainability North America at the Coca-Cola Company, with us from Minnesota. Of course, Greycroft, founded by Alan Patricoff. He's a chairman emeritus, but a well-known venture capitalist. This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. United Health Group boosted the lower end of its 2023 profit forecast today as quarterly adjusted earnings and revenue beat analyst estimates. The company said adjusted earnings for the year will be between $24.70 and $25 a share, increasing the bottom end of a forecast given in April by 20 cents today. United Health Group shares advanced 7.2%. Citigroup, the world's second largest credit card issuer, is reaping the gains as customers borrow more, even as a growing number struggle to make payments. But Citigroup, after earnings today, tumbled 4%. Ken Leon, who covers banks for CFRA, sees more work ahead for Citigroup.
I think Citigroup's on the right course, but investors have been burnt waiting for Godot in essence of a full turnaround. Jane Fraser has the right strategy. She needs time. And when you're trading at such a low price to net tangible book value, there's opportunity. So the question is, this is an attractive value or it's a value trap? We think it's more promising, but we still have a hold rating on Citigroup.
And you can hear more of that conversation with Ken Leon on the Bloomberg Business Week podcast. You can download it wherever you get your podcast. Today, we did have shares of Citigroup, as I mentioned, down by 4%. Among the other big banks out with earnings this morning, we heard from JP Chase. That stock up today by 0.6%. Wells Fargo, after earnings, down 0.3%. Those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
Shaking my head left and right here. Carol Masser along with Matthew Miller in for Tim Stenivek on this Friday. We're going to do a little bit of world and national news, Matthew.
Yes, let's get over to my buddy Dan Schwartzman in the Bloomberg 1130 newsroom in New York.
We're buddies now. It's so cute. What a great Friday it's been. Carol and Matt, always great to be with you guys. Biden administration announcing that over 800,000 student loan borrowers will have their debt wiped away in the coming weeks. Officials say that fixing past administrative errors that miscounted borrower payments will be leading to around $39 billion of debt being forgiven. Biden is looking for alternative methods to forgive student loan debt after the Supreme Court last month struck down the administration's loan forgiveness plan. Rex Heuermann has been charged by a grand jury of 6 counts of murder and has been remanded without bail after being arrested for the infamous Gilgo Beach murders on Long Island, New York. Heuermann has pled not guilty to the charges through his attorney and will next have a court date on August 1st. Some details on this guy. He is a married father of 2 who's an architect and owner of RH Consultants and Associates since 1994, lives on Long Island, works in Manhattan. Police say advanced communication analytics were used to lead them to the suspect. On the heels of the just ended 74th NATO summit, Secretary of State Antony Blinken, who's at the ASEAN Summit of Southeast Asian nations, highlighted all that Vladimir Putin has done to weaken Russia with his ill-fated invasion of Ukraine.
The damage that he's done to his own country is extraordinary across the board. It is militarily, economically, much weaker than it was. Its standing in the world has plummeted. 1 million Russians have left the country.
Secretary Blinken speaking while in Indonesia. UPS preparing for its workforce to go on strike. They're planning to train non-union employees to deliver packages. The current 5-year contract between UPS and the Teamsters Union, which represents 340,000 of its workers, expires at the end of the month. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg. Carol and Matt, back to you both.
All right, Dan, thank you so much. Carol Masser along with Matthew Miller, live in our Bloomberg Interactive Brokers studio, streaming on YouTube and, of course, on Bloomberg Originals. And it's been quite a week. And then I would just kind of take a look at what is among the most read stories on the Bloomberg. Do you know you're doing a live show here?
Yeah, but listen, there's actual news happening. So I'm trying to keep up with.
What are you trying to do?
I'm trying to book the chief negotiator for the actors.
Okay.
In this strike, Duncan
So,
Crabtree.
are we
Ireland.
close? Are we close?
I might be able to get Duncan. Yeah.
Is this just because you want to get out early?
That's the other thing. I want to leave 5 minutes early.
Stop it. All right. I'm just looking at stories. So we're watching this. I don't know.
You're looking at what? The most read stories? Wall Street's reversal curbs bond trend, trader euphoria.
Do you know what's among?
It's just a market trap.
Do you know what's really interesting? You know what's among the most read on the Bloomberg for the past week? Don't cheat.
You look for 1 week? Okay, I won't.
I love doing